He's coming. I watched it. Yeah. I mean, just to see what Ozzy. Then I got my mail this morning and had to open a checking account with get a bonus. Yeah. But I've been in jail since my banks used to pay. But he's using it for names. So,
Much nicer there.
great. Yes, I should mess with Zoom.
You're gonna mess with Zoom.
Well, this is not my paper. So, if I don't mess with Zoom, I'm gonna have an interesting time.
Which one would you like?
Yes, that one, perfect. And I'm supposed to stay up here?
Yeah, you're supposed to say it. Yeah. Let me say a few things and then I'll turn it over to you.
Okay.
Okay, let's get it going this afternoon session. Let me just remind people that are new to the room about the ground rules. There are 45 minutes per paper. We kind of have light questions throughout, and then we ask the authors to end a few minutes early so we can have a few questions at the end. For the presenters, it's good if you stand here because this is live streamed and this is where the mic is and so on, but I'll let you guys internalize that yourselves. And for those asking questions, it's also wonderful if you can ask them into the mic, but you know, I'm sure we're not going to bat 1,000 on that. Gabe, first paper.
Okay, thank you very much for including this paper. This is joint with Ed, who's over there, Javier, who's over there, and Avi, who is right there. Okay, there's a few things that we're going to do in this paper, but I'm going to get you into it in the way that we got into the topic, which is asking how should a consumer price index treat the cost of shelter. So let me start with what the US currently does. These are two lines that measure the cost of shelter for renters, that's the orange line, and the cost for owners, that's the dashed red line. These are put into dollar terms by just equating them to the 1996 average rent. What are these? So rent of primary residence, the Bureau of Labor Statistics runs a survey of properties. It runs this every 6 months, and then shelter inflation for renters is a 6-month change, or the 6-month root of the 6-month change in the shelter inflation of those rental properties. There's some subtleties with the lags. That's not going to be the part of what we're going to talk about. The red line, what's called owner's equivalent rent, takes that same survey of rental properties and reweights the rent growth so that the properties look more like owner-occupied properties rather than rental properties. So think putting more weight on single family rather than multifamily housing. Okay, I've written a few papers about housing. Ed has written like 100 papers about housing. In housing, the usual way of thinking about the cost for owners is a user cost. So I've plotted here 3 different measures of that user cost. So the user cost is you come into a period, you buy a property, you make a down payment, you make a mortgage payment, some maintenance, and then you sell the property at the end of the period. So there's 3 measures here because there's 3 different ways of capturing those expectations of what that house price capital gain will be. One uses the full sample average, one uses data from the Survey of Consumer Expectations, the New York Fed, and one uses a Bayesian VAR that I'll talk about at the end of the talk. If you look at these 2 lines, the owner's equivalent rent, or 4 lines, and the user cost measures, you don't need a lot of high-powered econometrics to say that these are different. The user costs are much more volatile. They're different in levels. And if you have some questions about how we exactly constructed it, look at this far right part of the picture where we're doing monetary. The Fed is hiking interest rates. Rising interest rates raise the user cost because they raise the cost of a mortgage. Also, for the 2 measures that have time varying expectations, as rates go up, expected house prices expected house price appreciation goes down, and so that further pushes up the user cost.
Do you never predict enough house price appreciation to get a negative user cost?
You can have a negative user cost. There's some in there. Yep.
I guess I was looking at the 2000s. That was a period when there wasn't enough, anticipated persistence to generate negative user costs, I guess.
Using our Bayesian VAR, no. One thing we don't have from 2005 is great measures of house price expectations.
How well the Bayesian VAR, deals with extrapolative counts or, a question.
So it looks pretty close to the survey consumer expectations in the overlapping period, and then we use it to extrapolate to other term structure expectations. But we're not going to go back to the early 2000s for this and some other reasons.
So the level of hyper's momentum and longer term Uber global level needs to get tons of local negative stuff on various times.
Yes, we can talk at the very end about extensions of this paper, including doing some geographic heterogeneity. Okay, so these two things look very different. Why does the BLS use owner's equivalent rent? Because in the standard user cost model, people are indifferent between owning and renting. You can move all the time. And so those are two different ways of consuming shelter. And so they should be the same. So we're going to conclude from this time series divergence that owning and renting are not perfect substitutes, and that there are things that are not in the one period user costs, transaction costs, and multi-period contracts that make owning dynamic. And so the purpose and the project of this paper is to ask, what should a price index for shelter look like when we have this imperfect substitutability between owning and renting and these long-term contracts and ownership spells? Just to remind you, if you don't need, probably don't need a reminder of how much this matters, here's a little bit of data on CPIs around the world. So in the US, the total shelter weight of the CPI is about a third of the total index, 7.5% for renters, 25% for the owner's equivalent rent. The US PCE, which is the target of the Fed, has a little bit lower weight, but similar structure. And then you look around the world, and different countries are doing all kinds of different things in how they measure the cost of owner-occupied housing, excluding it totally, only using the mortgage part and the interest, but not the capital gain and the user cost. And there are even some countries like the UK that measure no owner equivalent rent, but leave that out of what they target for monetary policy. So there's a lot of heterogeneity around the world, and to us that reflects the absence of a good theoretical rationale for what we should be doing. Okay, here's what we're actually going to do and what I'll do in the talk. So I'm going to start by breaking that equivalence between user costs and rents in the simplest way, which is only introducing this heterogeneity in the preference for owning and renting. And I'll show in that context, the right thing to use is the one period user cost. Then we'll bring in the dynamics, the transaction costs, and things are going to get a little bit more complicated. We'll characterize a value function for owning versus renting, and then we're going to define a price index as the time path of changes in utility that sum to changes in the value function, but we're going to get the whole path and match that to the path of price changes. We're then going to try and measure this. So I'll start by talking about a survey we ran of households trying to elicit this preference for owning versus renting. We're going to find a willingness to pay to own that's heterogeneous, consistent with the theory, and has some positive mean. It's higher for owners. We're going to use that survey along with a lot of other things to try and calibrate a dynamic model of tenure choice. So whether people are going to own versus rent and their decisions over time. We're going to put in that model lots of things: moving costs, fixed rate mortgages, down payment constraints. And then in the context of that model, we're going to do quantitative exercises. So the first is going to be what happens if mortgage rates go up, nothing else changes. And we're going to show in that impulse response how much our shelter index moves. Owner's equivalent rent, of course, wouldn't move at all if only interest rates change. And then our main quantitative exercise is going to be a historical index over the inflation surge and decline of the 2020s. Yeah, Emmy.
So it, of course, makes me think back to, before 1983, when the measure in the United States was more like this. And then around 1980, when Volcker raised interest rates, it went directly to the CPI. And I guess one of the thoughts that occurs to you then is the question of, you know, the CPI for what purpose? And in the context of monetary policy, of course, if you put the interest rate into the CPI, like in 1980, then you have this kind of weird thing, maybe weird thing, that you're like stabilizing the interest rate by stabilizing the CPI. And so, you know, I guess my question is, I'm sure you've thought about the, you know, who's the user that you have in mind? So I wanted to just hear your
Yeah.
thoughts on that.
So we think of the CPI as what it says it's doing, which is measuring the cost of living. And then what monetary policy does might be different. So I'll three marks. The first is countries do this differently. The UK has a different measure for the overall CPI and what monetary policy targets. The Bank of Canada has the interest stuff in it and has found ways around it. But more broadly, the Fed can decide they want to target a CPI that excludes this. And Kevin Warsh can set up a task force and ask people to decide what they should target, and they could do one that excludes interest costs. There's actually a rationale for doing that, which is increases in interest rates are sort of like classic cost push shocks. They raise prices without affecting demand. And so there's a pretty good rationale for saying the Fed should be targeting an index that excludes them, just based on our standard theory of not responding to supply shocks.
A lot of things. Great.
Sure.
I think that most retired people that are getting regular homeowners.
Yeah.
All for totally different people.
Right. No, I think it's just interesting in the context of the fact that we historically, we actually have both, you know, for the period before 1983, but distinguishing between them has never been something anyone has done. So of course, like this kind of clarification is probably important for doing that. But
And-
you know, historically interesting.
The debate when they changed in 1983, they did things like plot user costs and rents, and they said, oh, these look pretty different, and they just never resolved it. And they said, well, it's kind of easier to measure rents, and if we measure user costs, we have to measure expectations, and that's hard. So, well, so they weren't at the BLS. They weren't thinking about the problems for Volcker. They were thinking about this conceptual thing, and they just never resolved the difference.
Very difficult, taking decades, we've got all kinds of contracts and taxations, one thing, not the other, lawsuits. So actually changes the physical implication of taxation actually didn't make sense, especially once you issue inflation index bonds.
Sure.
If you were to change right now, the way, if you were to change the way you calculate CPI, there would be many lawsuits for block index bonds. Because of what changed.
So the way the UK does is they publish now 3 headline indexes: the retail price index, the CPIH that has owner occupied housing in it, and the CPI that doesn't have owner occupied housing in it, and which is the target of the Bank of England. So we could do that with the right resources given to our statistical agencies. Yeah. So in our quantitative exercise, we're going to do fixed rate mortgages because that's predominant in the US. There is absolutely nothing conceptually that would prevent us from using fixed versus floating rate or having both. All right. So let me do this first in the simplest context. So people are going to consume 1 unit of shelter. They're going to own or they're going to rent. We're going to keep that assumption throughout the whole talk. If you rent, you're going to pay a rent of R. We're going to normalize your non-pecuniary utility from shelter when you're a renter to 0. So your total utility contribution when you're a renter in money metric terms is just minus R. If you own, this is going to be a frictionless environment to start. So if the 1 period user cost is going to apply, you're going to buy a house, make a down payment, you're going to make an interest mortgage payment on that mortgage. You're going to pay some maintenance. You're going to sell it back at the end of the period. And we're going to call all of that the 1 period user cost. If you own, you're also going to get some warm glow utility from owning. That's going to be indexed by theta, and it's going to vary across individuals. So think of this as like a preference for being able to customize your house, as a preference for not having a landlord who can come inspect your property at any time, anything that makes you not perfectly indifferent between owning and renting. So your net utility, contribution to utility if you own, is you get your theta, and you pay for the cost of owning, which is that user cost, rho PH. This is a simple model, so there's going to be a single cutoff. Let's call that theta star. If your theta is above theta star, you're going to own. If your theta is below theta star, you're going to rent. And that theta star individual is going to be just indifferent. And so the wedge between the user cost and renting is going to be just that theta star. And so I'm going to use that theta star as that wedge in a moment. The home ownership rate is just then 1 minus the CDF of the thetas up to the theta star. And notice I'm not doing anything here to specify the supply side of building or converting between renting and owning. I'll do that for about 2 slides later on in the talk, but for doing a consumer price index, the consumer is taking prices as given. So we're going to do most of this in partial equilibrium, taking prices as given, and then measuring the consequences for welfare. So So I'm going to put in later financial constraints. I'm going to put in more stuff later, and that will matter, and it's going to affect the sorting of who rents and owns. Now we're keeping it simple. Okay, so how do we define a price index? The standard economic approach to a price index is doing a static expenditure minimization problem. So this is sometimes called a Kunis index. So for a type theta, we're going to say the change in the price is a change in the utility they get between t and t plus 1 as rents change, house prices change, mortgage rates change, anything that affects their cost of owning versus renting changes. Once we aggregate that up over all the types theta, we get this result, which is that the total change in the price is going to have a change in the rent. Then there's the premium of how much owners are paying relative to renters. So remember, theta star was that wedge between the user cost and the rent. So HT plus 1 times theta star T plus 1, that's the total additional cost for housing that owners are paying at T plus 1. Difference that from T, that's the change in what they're paying between T and T plus 1. And then there's this change in the non-pecuniary component, because if the home ownership rate changes, we're going to get a difference in the total mass of the thetas of people who are owning and enjoying the benefits of owning relative to renting. 2 special cases. One is, let's do a degenerate distribution of theta. So a degenerate distribution of theta means this term's going to be 0. This term's going to be 0. Rent changes are going to perfectly capture changes in the cost of owning as well. So that's the case where owner's equivalent rent gets it right. But that's the case where we can't rationalize any difference between the user cost and rent. They're going to perfectly track each other. Another example would be a change in the user cost. Let's suppose mortgage interest rates go up, and keep things simple again, rents stay fixed. So what happens to our price index then? There's going to be an increase in the cost of owning that's borne by those who are owning in the types of thetas who are owning in both periods. And then there's going to be this change in the extensive margin, consumer surplus, which is the change in the people who are owning times the foregone surplus that they were getting when they owned and now are renting. So that's the theta minus the theta star averaged over all the different types of theta. So in the second case, using rents would get the thing wrong. Using the user cost gets it right, adjusted for then this non-pecuniary component of owning. So that's the simplest case, and it tells us that once we break that equivalence result, it's the user cost that matters, not rents. Yeah.
OER is predominantly rated by human rents, not market rents. Which it seems like here this really refers to market rents, right?
So this is a frictionless environment. There's no transaction costs. There's no distinction between market rents and existing rents. And then a second, move forward into a dynamic case where you could make that distinction. There are some reasons that we're not doing that in the quantitative framework we're doing right now, but I can come back to that when we get there. Yeah. I'm going to put that in. Okay. Yeah. Yes.
Then that confidence. Like what this shift in the composition is happening, is it like that, the share of spend? The rental and the home housing is changing.
Yeah, so this only shows up if there's a change in the home ownership, right? If HT plus 1 is different from HT, so that's this. Since which is second order, it's that change in the home ownership rate times the surplus people were getting when they were owning. I'll come back later and show you first order versus nonlinear price indexes, and the substitution is going to matter in this case, and maybe it matters more quantitatively than in some other cases. That's something that we can discuss. Okay. So simplest model, can't use just rents anymore. Now we're going to put in some dynamics and allow for more of these different types of heterogeneity. And I need to give you a theory result of what happens in that case, and then we'll go to the quantitative results. So what do I mean by dynamics and multi-period contracts? So now let this bold W be the whole history of prices. So house prices, rents, mortgage rates, all of that's in the bold W. I'm going to let S denote how long somebody has lived in their current residence. And so how much are they paying for shelter at date T? That's going to be some function X that depends on, were they owning last period? Are they owning this period? When did they last move? And what's the history of prices? And so if you own today and you bought 10 years ago, how much you're paying for shelter today depends on the house price and the mortgage rate 10 years ago. That's the sense in which this is dynamic. It also means that your decisions today affect how much you're going to be paying for shelter in the future. I'm going to have a non-shelter good, let's call that C, okay, where you get utility U of C. So the standard price index without these dynamics would be you get some date T shelter costs and you find the minimum expenditure on the C and on shelter to get one util. The dynamic analog is a value function. So we can ask how much more transfers do I have to give a household to make them indifferent at old and new prices, where indifference would be over that value function, the whole present value of utility. And the exercise we're going to do is move from value function space back into per period price space by using the actual timing of when those flow utilities are changing. Yeah.
How about the pricing aspect? So I guess fully engaging with the dynamics might mean that you're also thinking about the return on housing in the context of there being some risk in housing and so on. How are you thinking about that?
So we're going to include all of that, and then I'll show you some pictures of what happens if we take out surprise capital gains or surprise inflation that erodes mortgage balances. But conceptually, if you start from the economic approach to a price index and say, I'm gonna have to fix the utility, you can't really get away from that stuff. But we can give you some alternatives or give a statistical agency some alternatives where we take it out. I'm going to consider perfect foresight paths of changes in the WT. And in the background, Aero-Debreu markets over all idiosyncratic shocks. And we can relax that too, but it gets more complicated. Okay, so a little notation. Capital theta is now going to be all the exogenous dimensions of heterogeneity. So it's a little theta, the preference for owning versus renting, but also maybe you're more likely to move if you're a renter relative to an owner, or you have a constraint that means you can't make a down payment. All of that's going to be in that cap theta. So an individual is going to enter period T, and their state is they have some initial non-shelter assets, AT minus 1. They have, were they coming from owning or renting? How long were they owning or renting last period? And then their cap theta. So all of that's their initial idiosyncratic state. Let's call that cap omega. So the first object dynamically to define is the expected present value of spending on shelter. I'm going to call that Vx. So remember, X was how much are you spending this period? Vx is your present value of spending on shelter. So it's the expected present value discounting at the market discount factor of all those future shelter payments that you're going to make. I can likewise define a present value of your utility from non-shelter consumption. So that's the present value discounted at the subjective discounting factor of all your future utility flows. I'm going to convert that back into money metric space by dividing by the marginal utility consumption, and I'm going to call that VC. And with the Arrow DeBrew markets, one of the things that's going to bias, that's going to make this more tractable, is this VC just depends on your total wealth net of what you're going to be spending on shelter. So it depends on your initial assets, less all those payments you're going to have to pay for renting or owning. That's what you have available to consume non-shelter goods. Then you have your V theta. That's how much present value of utility am I going to get from being an owner. So that's the expected present value of all your future thetas that you're going to get from owning. And so then your total welfare in a value function is that VC, total utility from non-shelter consumption, plus the V theta, all those thetas you're going to get from being an owner relative to a renter. Okay, so now the game is going to be to perturb the W and think about what happens. When I perturb the W, I'm going to keep that U prime of C fixed. So that's fine for small changes in W. It's an approximation for larger changes in W.
So not kind of asset pricing assumption or?
No, because there's still house price capital gains that are going to matter here. They're going to matter more to an individual than the aggregate, because most of that is going to wash out if you own and I buy from you and the house price goes up. That's good for you, but it's bad for me. And so when we aggregate over the whole set of households, that mostly washes out. It doesn't totally wash out because you might not sell to me. You might sell to a private equity agent that's going to convert from an owner to a rental, and we don't capture their welfare in the utility function. Yeah, so, but that's, it's a different thing from, is there any asset pricing going on there? That's more of a, like, one way to think about this limit is a limit where you have linear utility over the non-shelter good. So quasi-linear utility over shelter and the non-shelter good. So I have a U prime of gamma, or U prime C is C to the minus gamma, and you can think of gamma as going to 0. Okay. All right. So notation, dy is the change in y, where y is, you know, some function before and after this unexpected change in the w's. So what's the change in the value function? That's dv. Okay. What is the change in the value function at date t? It has two components. One is I'm now going to be changing how much I'm spending on shelter. That's the dvx. If I'm spending more on shelter, that's bad for me, so minus dvx. The other is I'm going to change whether I'm owning or renting. So I'm going to change all those thetas that I'm going to get in the future because I'm going to change my tenure choices. So minus dvx, change in spending on shelter, plus the dv theta, those values of owning versus renting. So that's in value function space. The key to how we're going to define a price index is not only does the intertemporal budget constraint tell us if you're spending more on shelter, you have to spend less on non-shelter goods. That's a way of thinking of the dvx. But we also can trace out the whole time path of when you're going to change your spending on the non-shelter goods. And that time path is what we now call intertemporal marginal propensities to consume. So if prices change at date t, how much am I going to change my non-shelter utility at t plus j? That's the change in the wealth at date t times how much I change my consumption at t plus j periods ahead, if I have a change in my wealth at date t. Yeah.
So isn't it right that the CPI is a Spears type index? So wouldn't that last term, this like some people switch from being homeowners to renters, that wouldn't be a part of that kind of a thing?
Yeah, so when I defined our price index as the economic approach to the price index and the change in utility, I'm not literally doing that's not a pure Spears. It's allowing for some substitution. The PCE does allow for some substitution. So if you want me to think of consumer price index is a little bit loose on that. And again, I'll show you what happens if we don't allow for any substitution. So I'll show you how important that is. All right, so that's going to be our price index. It's the time path of changes in consumption and the time path of just changes in the non-pecuniary utility. A useful result is inflation then is Markov, in the sense that the inflation in shelter at date t depends only on what's my surprise and how much my total present value of spending on shelter is going to be, times how much I change consumption today, given that I have some change in non-shelter wealth going forward, and then the change in that non-pecuniary term. Okay, we can have incomplete markets. With incomplete markets, things get more complicated. Instead of having consumption, we have certainty equivalent consumption running around. So I'm not going to get into that in the talk, but it's in the paper. All right. So now I want to tell you how we're going to bring this to data. So first, we ran a survey. So we ran a survey of 1,000 individuals. We tried to elicit their willingness to pay to own versus rent. How did we do that? We asked them a bunch of questions, and then we showed them a side-by-side comparison of how much, what your actual outlays, what those X's would look like if you own versus rent. So you make a down payment versus you take the money you would have put into the down payment and you invest that in a diversified portfolio. You make mortgage payments, you make rent payments, etc. Then we tell them, suppose after 10 years, your terminal wealth is the same, whether you owned or you rented. So we're going to try and fix that VX component. If you could go back 10 years before, would you still have chosen to buy? And we know if you bought or you rent, so this is the question we ask of owners. If you rent, we would ask you, would you still have chosen to rent? So if somebody says, okay, given that I'm fixing the total amount of spending I would have done on shelter over 10 years, I fixed my terminal wealth, I still would have chosen to buy, then we ask them, okay, tell us, how much more would you have needed in the rental scenario? Suppose the stock market did really well, and so you wound up with more money from investing the down payment than you did in the housing market. How much more would you have needed to make you have chosen to rent rather than buy? And so they tell us some amount. We can do this with a slider. We can do this with repeated menus. It doesn't really change. This is what we get. So this is the distribution of the willingness to pay to own as a share of your rent. Okay. So there's some variance. That was the first premise of what we were doing, that there was some heterogeneity. Does that variance make sense? I'll give you a couple of senses in which it does. First, revealed preference. People who are currently owning have higher willingness to pay to own than people who are currently renting. And the difference is about 15 percentage points of rent. Second, we did a follow-up survey 4 weeks after the original survey. We tried to mask the connection. We then asked a similar question. People's preferences are reasonably stable over time, and we're going to use that difference to correct the variance when we take this to our quantitative model. Third, there's an age profile to this willingness to pay to own. It's pretty low when you're young. It goes up as you get into the age where you have kids. Maybe you care more about being in the right neighborhood that is dominated by owner-occupied housing. And then as you get towards the later stages of life, it declines again as people tend to be willing to downsize. Valerie.
You phrased the questions, but it seems like you might be omitting what I think for a lot of people, one of the benefits of owning is, which is the insurance against price increases in a major part of your household budget, because you're basically rotating it through an endowment point. And I was wondering if you had any thoughts on that.
So when we do this elicitation, we think that we're trying to not capture that part because we're doing this in terms of terminal wealth. But conceptually, if that were part of the theta of why people want to own, I don't think we would have a problem with that. Josh and then Kunal.
There isn't much of a rental market in
single family homes in lots of places. So if someone were to ask me, would you prefer to rent? My immediate thought would be, I have to live in a very sort of dwelling.
So the question of why there's not a rental market in single family homes is a great question that Ed can tell you about for 3 hours, but we don't have enough time left in this talk for. In terms of the survey, one of the things we did randomize was, are you renting the same house, or do we not specify that it's exactly the same house? People have a little bit more willingness to pay to own when it's not specified to be the same property. And one way to interpret that is they're thinking about things like, I want to be in this particular neighborhood, and that means I have to own. So I do think of that as part of the theta.
It seems like the distribution of these thetas are like idiosyncratic shocks, so give you the different stability. I was wondering what the benefit of measuring that distribution is versus just trying to measure like elasticity of substitution.
I'm going to run a little bit longer than that because I've had a lot of questions, which I'm happy to take, but they're just coming in the flow. So yeah, we're gonna have some idiosyncratic taste shocks to smooth things out a little bit. We think of the thetas here as being not just sort of something residual, but something that's sort of fundamental to what we're doing. And so in advantages, do they actually map onto something? So there are, we're not the first paper to put thetas into a housing market, and the typical thing to do is to use them to calibrate that demand slope. So that's what Dan Greenwald and Adam Gurn do. We think of this strategic elicitation as giving some actual meat to that interpretation. All right. So let me tell you what I'm going to now add into our quantitative model. So there's going to be some fixed costs of moving into a new rental and of selling a home. Think of these as a brokerage fee and a payment to the real estate agent. There's going to be a non-shelter price, PC, inflation, pi c. Think of everything I've shown you so far as in real terms relative to that price of non-shelter. Why are we bringing this in? Because one of the things that's going to matter a lot in the inflation surge and decline is there's a big increase in non-shelter prices, and that's going to matter for homeowners who have fixed rate mortgages and nominal mortgage balances. So we're going to have those fixed payment mortgages. We could have variable rate mortgages. Thinking about this in other countries that have different mortgage structures, I think is really interesting. It can all go into this framework, but quantitatively, we're trying to do this for the US. So we're going to do fixed payment mortgages, some option to refinance, additional heterogeneity. So both of these came up already. You might be more likely to move if you're a renter. So if you're a PhD student, you probably don't buy your house because you're expecting to move in a few years. So with probably lambda, an agent of type lambda is going to have to pay some cost to avoid a forced move. Some fraction of agents just can't make a down payment and buy a house. So that's going to be a zeta equals 1, liquidity constrained and can't buy. There's a life cycle. So agents are going to be born at age 25. They're going to draw these theta, lambda, and zeta shocks. And then what does age mean? It's going to be age-specific transition rates across different values of lambda, theta, and zeta. And then they're going to die stochastically after age 65. And I mentioned to Kunal, we're going to have some extreme value shocks to sort of smooth out across all these discrete decisions people are going to make. So we're going to calibrate this in blocks. Our survey is going to directly give us a calibration of that theta block. We're going to calibrate zeta, that ability to make a down payment using the survey of consumer finances. We're going to externally calibrate a bunch of things, and then we're going to jointly estimate a number of parameters to match transition rates across owning and renting, rent-to-rent transitions, own-to-own transitions, that premium from the survey, and an overall home ownership rate. I don't have time to tell you about all of the economics of this moment matching, but we can do a pretty good job with this in the model. To give you one slide reminder of what's going on here. So this is a heat map in the steady state of who owns and who rents. The purple is your down payment constrained. So we got a set of agents who just are definitely renting by being forced to. The middle panel is people who are not vulnerable to these mobility shocks. They're going to own if their theta is positive, if they get some additional utility from owning, otherwise they're going to rent. The right panel is people who might have to move a lot. And if you have to move a lot, you'd rather rent than own because the transaction costs are lower for renting than for owning. And so you need a higher theta to rationalize owning if you have these mobility shocks. All right. So now I'm going to do two quantitative exercises. The first sort of warm up is going to be an impulse response. So let's just suppose the real mortgage rate goes up by 2 percentage points. Nothing else happens. Rents stay flat. We're going to allow house prices to respond endogenously to that increase in mortgage rates using a supply side that we take from that Greenwald and Gurin paper I mentioned a moment ago. So this is what house prices are going to do in this scenario. They're going to fall on impact and then slowly over time. Home ownership is going to fall and decline slowly over time. Why doesn't it all happen on impact? Because there's some mortgage lock here. If you're an incumbent owner and you have a low mortgage rate, you don't sell immediately, even though mortgage rates have gone up because of your fixed rate mortgage. Here's what happens to different price indexes. So the blue line is going to be our preferred total price index that I've described. It goes up by 2.6%. So that's the shelter price index. If you want to think about a contribution to the total CPI, think about multiplying that by like a third. The orange line is how much of that is coming from the consumption component, the VX, rather than the thetas. Most of it comes from the consumption component. The purple line is what happens in the first order. So the first order is we fix everybody at their steady state decision rules and distribution, and then we apply these changes in prices. So this would be more like the NBER's case, and it's going to overstate this shelter inflation for the usual reason that we're not allowing for substitution. And it's a pretty large difference here. So going back to Danielle's question, the first order gets things, sort of meaningfully wrong. On the right, and I did this on the right because the axis is very different on the right, I have two stark alternatives. One is owner's equivalent rent. That doesn't change by construction. The green line is the one period user cost. This goes way up when mortgage rates increase. Why does it go up so much? That mortgage rate increase is applying to everybody, and people are taking into account the fact that prices are going to decline. So the one period user cost vastly overstates the total effect on inflation. Our main quantitative exercise is then to do this in the context of the inflation surge and decline in the 2020s. So to do that, we're now going to go back to partial equilibrium. We're going to make the model exactly match what real path of house prices, mortgage rates, rents, expectations of all of those that come from financial markets and that come from our Bayesian VAR. We're going to make it match the home ownership rate as well, feeding in some residual demand shocks I can talk about later. And then we compute our price index. No. Yes. Okay, perfect. I'm going to just keep taking questions in the flow because otherwise I won't finish. All right, so this is what we're feeding in. So these are, think of these as relative to the path of non-shelter inflation. So non-shelter inflation is going up in this period. Relative to that, real rents are declining and then they rebound. Real house prices are going up even fast. So house prices are going faster than non-shelter inflation. So real house prices go up. Mortgage rates, of course, go up once the Fed starts its tightening cycle. And that's what's happening to the non-shelter price relative to trend. Here's what our price index looks like. So these black circles, that's our price index. The triangles are what's the part of that that's coming from the consumption part, the VX. So again, most of this is coming from the consumption part. That doesn't mean the thetas don't matter. They do matter because they're affecting the selection into who's moving from ownership and not, but the direct quantitative parts of the consumption. And the black triangles are what is BLS rent and owner equivalent rent doing. So our index is falling less in real terms during this inflation surge, and then it's growing much less during the inflation decline. And so if you used our index, the Fed would look a lot better in 2023 and 2024 than it did in practice. Where is this coming from? So we can plot different contributions. There's a decline coming from rent, as I showed you, goes down in real terms. And then there's a big increase that comes from the Fed raising mortgage rates. So this goes back to Emmy's question. Certainly mortgage rate increases are feeding into inflation in this index. And again, we just think that's unavoidable if you're going to actually measure the cost of living and owning to households. So we can do different things to take out some of these capital gains components. So the blue line here, again, that's our overall index. The green line is what if we take out that surprise inflation? So surprise inflation is good for households because you have a bunch of owners who have fixed nominal mortgage balances that get eroded when you get inflation in 2020 and 2021 and 2022. So if we take that out, we're going to get a little bit less of a price decline for owners. If we take out the capital gains part, that's also going to reduce the price decline. Capital gains are good for sellers. They're bad for buyers. And so if you take them out, you're only left with the bad for buyers part. And so that's going to make inflation look worse for shelter. Okay, now I think I actually am coming to the end. So let me wrap up and put this into a broader context. So we tried to produce a new approach to a cost of living shelter index. It's quantitatively different post 2019 in a very important inflationary period. You could think of this applying to durable goods and intertemporal linkages more broadly, and we're very sympathetic to that. There are reasons that housing is where we started. It is by far the most durable good, and you really can't get away from intertemporal linkages in a product where everybody has a mortgage that links payments over time. So where I'll end is, can we actually use this? And on the one hand, you might think, well, it seems kind of complicated. You're solving a value function. Is the Bureau of Labor Statistics really going to do that? And I want to leave with two answers. One is owner's equivalent rent is not something that's very easy to explain to the person on the street either. So it's not like we're starting from something that seems to work very well. The second is there are alternatives to doing all of what we're measuring through the model. We could run more surveys, get people's house price expectations, find out how much their consumption is responding to changes in house prices expectations. And we could lean a lot more on the data than we are in this paper, simply because we don't have that measurement apparatus yet. But as a practical prospect, there may be ways forward that could bridge the modeling we're doing with something that would be more in the usual flow of what statistical agencies are doing. If I left any time for questions, I'm happy to take them. And if not, I'm happy to take them at the break.
Yeah, but I think we should move on. Let's thank Gabe for the paper. And Joseba will be presenting the second paper.
Yeah, that's the one. Thank you. Thank you. Okay, so afternoon, everyone, and thanks, Sammy and John, for including us on this wonderful program. So this is joint work with Germán Gutiérrez and Thomas Philippon and Sophie Piton, who's right here, and Sophie is at the Bank of England. So the disclaimer that these are not the bank's views applies. So in this paper, we're interested in studying the comparative evolution of prices in the US and in the EU. And here's, so the co-author team has two French people, either side of the Atlantic. So this is a price difference we're very invested in. This is the price of bread in the EU and in the US over a decade and change. retail bakery products. And, pretty striking fact emerges that if you compare the price of bread from 2005 to kind of 2019, as measured, the price of bread in the US goes up, 40 log points more than in the EU. And so in this paper, we want to understand whether this fact kind of generalizes and what are the implications of these price divergences, and can we make sense of why they happened. And to situate this is kind of in the broader discussions that are out there. So of course, affordability is a big theme in the world. So we're not going to be talking about inflation per se in this paper, but we do have something to say about the drivers of low frequency nominal price changes. And of course, there's an exciting debate about whether or not the US or the EU have divergent living standards. So I'm not going to answer that question for you today, but we will have, I think, something interesting and precise to say about whether that's the case or not. So let me dive into the empirical fact that motivates this paper, and that's this right here. So there's a lot going on here, so let me talk you through what's going on. So again, the comparative evolution of prices, US versus EU. And here what we've done, we split goods producing industries into two broad categories, what we're calling tradables and non-tradables. And so on the left, you see the comparative evolution of nominal prices in the tradable sectors in the US and EU. And on the right-hand side, that's the comparative evolution of nominal prices in non-tradables in the US and EU. Okay, and so I think the fact stands out pretty clearly. Xavier, one second, which is actually, go ahead, why not? Can I defer? That's going to be a very long conversation we're going to have, Xavier. So it's not, and I'll show you why not. Yeah. Okay, and kind of it's not in interesting ways, but so yeah, I'll get to this. So what these are value-added price indices. So this is the price of value added in each of these industries. And so what happens? So you can see kind of remarkably in these tradable sectors, nominal prices track each other extremely closely in the US and EU. That's very much not the case in these non-tradable sectors, in which we see this massive divergence to fixed ideas. By 2019, between 1992 and 2019, that gap is about 50 log points. That's about 2% per year difference in nominal inflation. Yes, please.
Because I would have just thought non-tribals as services, but.
Okay, excellent. Great question. I was going there next. So absolutely. So what we've done here is we've looked at, from the US perspective, what is trade penetration in each sector in the manufacturing sectors. And so what we're calling non-tradables, these are not intrinsically non-tradables, right? You can trade food in principle, you can trade cement in principle. These are goods in which, for either, let's say, physical constraints, cement, or for, let's say, regulatory constraints, the case of food, the US is a relatively closed economy. Okay, but this is from the US perspective. In most of these sectors, the EU is more open to trade. Okay, so the peculiarity here, the way we sorted these sectors, is from the US perspective. Yes, sir. It is indeed. We're going to get to input-output towards the end of the talk. Yeah, that's an important point. Okay, so what are the tradables? So textiles, machineries, and transport equipment. That emits one very important tradable, which is computers. I'll say why we emit computers from this shortly. What are the non-tradables? Food, wood and paper, chemicals, and metals. Okay, so striking fact, tradables, very similar evolution. Non-tradables is very big divergence. Okay, so let me describe in a little bit more detail the choices we've made here. So the first thing is we're focusing only on manufactured goods. Okay, as Amy just said, services are non-tradable. Why aren't we including services? Gabe told you the answer already. Okay, which is just in the US to figure out what the price of housing is takes one paper. The proposition would be we'd have to compare the price of housing in the user cost of housing in Italy and Germany and France, the one in the US. To us, that's a non-starter, at least at the kind of current level of where we're at. So we're going to be focusing on good sectors in which it's not that we're going to claim that prices are directly comparable, but at least we can get our arms around the differences and make statements that we're confident that we can defend. Okay, so the claim I'm going to make is that I'm going to be able to defend that this is indeed what is happening to prices in some meaningful sense. Yes. Well, so the euro-dollar exchange rate is relatively stable. I guess one way you can see that is if you think, law of one price and nominal exchange rates, you might expect something like this to materialize. Yeah.
Because it translates the tradables to dollars
the euro one as well, they would also show the same.
So I haven't done that, so I'm going to say yes, but I'll check later. Okay, so there's not huge trends in the euro-dollar exchange rate. That's for sure. Yeah. Okay, so we're focusing on manufacturing. There we can get kind of comparable statistics. We are confident that these important differences in how these indices are constructed are not what's driving the result. Of course, manufacturing industries are not anymore very large in GDP, but as you can imagine, they matter a lot for consumption baskets, and they matter a lot for the incidence. When we put these differences in prices through the input-output network, that's going to matter for incidence and also for how regressive these changes are. So we've kicked out computers and electronics. I'll say exactly why in a second. Turns out it's a good idea to do that. And we're splitting by US tradedness, okay, by how open US industry is to trade. Of course, there's a very good reason to do so. Lots of reasons for why we think trade penetration could matter for firm incentives within industries. Okay, so with that said, that's our fact. This big divergence, about 53 log points in non-tradables, roughly 0 in tradables. Okay, so this is the plan. So I'll say a little bit more about this divergence, and I'll talk about this computer issue. And then I'll show you a very simple accounting time decomposition of the divergence, in which we're going to be able to say whether that divergence is driven by factor prices, by a term that's going to look like markups net of returns to scale, or broadly construed differences in technology. With that, I'll show you some causal evidence for US industries, and finally, we'll go to the input-output network, and I'll show you some implications of this price divergence. Okay, so back to aggregate price indices. Xavier, I promise I'm getting to CPI. Okay, so back to aggregate price indices. So at the bottom, you've seen this chart already. That's the evolution of tradables and non-tradables. And at the top left-hand corner, that's the evolution of the whole sector, or the whole manufacturing value-added price index. And you can see that the US in black and the EU, the dotted blue line, dashed blue line, they track each other pretty well. Then as we move to the right-hand column, what we're doing there is excluding these tech sectors, and then we see the stark divergence again. Okay, so this tells you that whether or not you exclude or include the manufacturing sector makes the computer manufacturing sector makes a very big difference to what you would conclude. And so why is that? Well, two reasons, and these are the reasons that we exclude computers from our analysis. The first is that starting in the 1990s, the US experienced this incredible boom in computer manufacturing. That was by far the fastest growing sector in productivity terms in the manufacturing sector. And the EU experienced no such comparable boom. Okay, so the EU makes other categories of electronics, but was not a big producer of computers. So we don't really have an apples for apples comparison for the computer sector in the US and the EU. Most saliently, and even more to the point for us, if you look in the middle panel there at the top, that's the value-added deflator for computers in the US and in the EU. So the black line is a very well-known fact that the relative price of investment has collapsed in the past 3 decades. That because of quality improvements in computers, in quality adjusted terms, computers have become very, very cheap. Okay, that's what that black line is showing. I think what's less well known is that in the rest of the world, that's not what happened to computers, at least according to statistical agencies. Okay, so the dashed blue line, that's the same number, the deflator for computers in the EU over the same time period. And you can see that there is no such comparable fall in the deflator. Yes, Annie?
That's one of the key sectors that should gone into probably pretty heavily used by the DLS and maybe different countries.
Okay, so we're sort of chasing this rabbit down the rabbit hole. So if you ask, France is one of my EU3 countries. If you ask the French authorities, what they'll tell you is we do exactly the same hedonics for computers as the Americans. So I have no idea what's going on here, and kind of no one does.
So that statement might be hard to define.
So, okay, so that's an excellent point. And this is essentially why we exclude computers. It's very hard to know whether what's going on here is something real or this is some statistical artifact. 1 second, and then, yeah, John, please.
Yeah, I mean, it just seems unbelievable that the European computers would be, competitive if this is the difference in quality that has occurred over this period. So, like, who would be buying these computers that are as expensive as in 1992?
That's right. So I guess this is like a Rorschach test, I guess, of what you think about technology and the evolution of the comparative evolution. Some people think the US deflates quality too little in computers. Some people think that it's too much. We're not going to engage with this debate. This is, of course, essential if you want to understand the differences in standards of living in the US versus the EU, because as you can see below, if you look at manufacturing labor productivity, whether or not you include computers, you see this very stark difference that for the US, if you exclude computer manufacturing from the calculation of labor productivity growth collapses. In the EU, it makes no difference. Excluding computers, labor productivity growth over our sample in the US and the EU is roughly the same. Yeah, Gabe.
A little bit wound up with the CPI versus
Yeah.
input output, but gross value added deflators are kind of weird relative to gross output deflators because they're usually double deflators. But
Yes.
sometimes they're not.
So here they're all double deflators. So that's at least that we have. Otherwise, yeah, this would be very difficult to do.
Think of that comparison because maybe the US industry, maybe the Europeans buying a lot of stuff from the US industry. And so, they're just different sectors. I mean, it's not quite how much do you sell the final computer for?
So I guess by the way, everything we do, we could do in gross output space, and all the facts essentially carry through. We do it in gross value added space because I guess that's how we write our models. And so it makes sense to us at least, this is an intuitive understanding of what a industry price is, but everything we do, we could do in gross output and it would go through. Yeah. Yes, Ricardo.
Better than you and me.
Yes. 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 Yes.
We make no computer, so that gross value added deflator is just fiction. Maybe you make one computer somewhere because of some cliches, which is important. And you're terrible at it, by the way, that's why I sound low. That would explain some of that discussion.
Yes.
In terms, you're traded and not traded.
Yeah.
And I get also something similar to that. I mean, you see the traded, you see trading back and forth. So those, the regarding advantage isn't doing much, and therefore the price take together. But if you call it untraded, well, it's going to be one direction because again, you're either seeing everyone buy one versus everyone buy the other. So I'm worried that the counterfactual that are moving is because those are based on essentially zero production.
Okay, so I don't want to get too hung up on computers because this is a wonderful conversation for why we're going to throw it out, but why we should think much, much harder about what's going on here. What I heard a little bit in there, Ricardo, is something about Balasta Samuelson, about how the US has this explosion in productivity growth. Surely that should matter for what's going on in the non-traded sectors. That's one thing we're going to be able to more or less definitively rule out as the explanation. I'll get there soon. Yes, yes. Yes. Yes, and to be honest, that's not a bad description of the world, right? So I can't think of the top of my head of any, French computer brands. I guess I can't think of any American computer brands anymore. Sorry, there were some more hands at the back. No? Okay, yeah.
Maybe the message is that the category is just too broad, that the Germans are specializing in certain electronics that, or medical equipment.
Sure, definitely.
Hasn't upgraded in decades, but
So,
the US especially.
so conceivably, so definitely hedonics. This is where hedonics happens. This is great. This is why we're kicking out computers. Yes, sir. So I honestly don't know what was going on in German computer manufacturing in the 1990s. What I can say is this is at least worthy of a lot of examination. This is why we kick it out. Okay, so on the subject of quality adjustment, of course, that matters for us too, because what I want to claim, what I want you to take away from this is that indeed there is this divergence in the prices of these non-traded sectors over time. Now, one thing that's plausible is that you might think, well, the quality of US goods is increasing faster than the quality of European goods, and BLS is just not good at measuring that stuff. Okay, so what I'm going to show you now is some evidence that suggests that in our little corner of the economy that we care about, these non-traded manufacturing goods, quality differences are not what's driving the dynamics. Okay, so first off, this is no longer industry value-added prices. These are now gross output prices. These are PPIs from the BLS down to more micro level, at which we can compare them to unit value prices from a database called Prodcom in Europe that records the value of produced goods, okay, in unit value. And so over there on the right, you can see a selection of products. These are products, some of these are the kind of stars of the IO literature. These products that we think are archetypes of very generic goods in which quality improvement is not a big factor, paper boxes and concrete. We also have frozen vegetables and our friend bread again. So in these goods in which we don't think quality adjustment is a big feature, we see, again, this divergence. The figure on the left aggregates up all these non-tradable products that we're able to match at the micro level into this index. And you can see there also we see this big divergence. I should say, on top of the fact that already we see a divergence between US and EU prices in these narrow categories, PPI from the BLS is a quality adjusted index. Okay, BLS are trying to quality adjust that index. The unit values out of Europe are not quality adjusted. Okay, so if you think that it's likely that if there's quality improvement in the US, there's also quality improvement in Europe, then this difference is actually underestimating the gap in nominal price evolution between the two. Okay, so we do not think that quality adjustment is what's driving differences in this comparison between the US and Europe. Now on to CPI. Okay, so what we've done here is for the categories of PPI that we can match to CPI with some confidence, we're comparing the evolution of CPI and PPI. Okay, so again, the same 4-quadrant picture. Non-tradables are on the left column, tradables are in the right column. Okay, so there's a lot going on here. So let me start with the easy part. Okay, so Atalay and co-authors have a very nice paper in which they say the US is doing too little. US labor productivity is much higher than you think. The BLS is doing too little quality adjustment in PPIs. Okay, and how do they know that? Because they go to CPI and they can see that in CPI, because of hedonics, there's a lot more quality adjustment. Where that is showing up in this picture is in the top right-hand corner over there. Okay, so for US tradable goods, apparel, furniture, but this is also true of vehicles, there's a very, very large difference between US PPI and EU CPI. We can trace using data on retail margins, retail and distribution margins, we can trace what should be the difference in PPI and CPI if there were no quality differences. When we do that, we obtain a very large visual in US tradables that says quality differences are a very big deal in US tradables. The BLS does very different things for PPI and CPI when it comes to tradables. Okay, clothes have hedonics, apparel, cars have hedonics, etc. What matters for us, though, is that if you look at the top left-hand quadrant, CPI and PPI trace each other pretty well over time. Okay, so even though in general there's more quality adjustment in CPI, PPI and CPI trace each other over time. Most importantly, that wedge you see there, we can explain as coming from retail and distribution margins. Okay, so we know why there's a gap there, and that gap is not due to quality adjustment. That gap is due to retail and distribution margins. Okay, so for the claim that we're trying to make, which is that there's a divergence in PPI prices, it doesn't look that quality adjustment is the issue. And also, as a bonus with this picture, I can tell you that when we think about PPI increasing, that also looks like it's going to translate into CPI increasing. Okay, so this stuff is being passed through to consumers. Okay, so yes.
Those don't make CPI. You don't read that for the US, Europe, right?
For non-tradables, correct. But for tradables, there's a very big divergence. You with me? So I'm talking about this red line, and this is that apparel furniture. Yeah. Okay, so this is basically the BLS does more hedonics for these tradable goods. The BLS does not do more hedonics for non-tradable goods. Okay, so to the extent that this means we're missing some quality, that's all happening in the traded. That is not happening in the non-traded. And for our fact, I mean, again, these things are enormously important because it sounds like you guys over here are wearing way better clothes than I am in Britain. Okay, that's what this data is telling us. Whether that's real or not, obviously, is an important question for cross-country comparisons. But for the fact that we are trying to persuade you of, which is that in that non-tradable category, in those goods in which the US is more shielded from international competition, there's big divergence in prices. Quality adjustment is not the issue. Yes, sir. That's correct. Yes. Oh, yes, I think you're completely right. Yes, yeah, yes. Okay, so great. Absolutely. Okay. So, all right. So we don't think, or the best evidence suggests quality is not the issue when it comes to US, this wedge between US and EU non-tradable prices. So what is, we're going to use a very simple accounting identity to attribute changes in quality to these different categories. Okay, so this is, pretty simple. At the top there, all that is taking logs of the definition of the value-added labor share in industry and splitting up into prices, wages, nominal wages, and real labor productivity. The change in the labor share of value added can be further decomposed into the labor cost share and that the change in the profit share. That term there is going to map directly to what in a model we would think of as the markup over marginal cost scaled by the degree of returns to scale in a production function. Okay, so when we put it all together, we're left with this expression here, and this is a decomposition we're going to be taking to the data. So the change in price in an industry is going to be a function of change in the wage, the change in real labor productivity, the change in the labor cost share, and the contribution of that markups net of returns to scale term. Okay, so we're going to be decomposing these changes into these four terms. Okay, so this is all producer prices still. Okay, so this could be either a gross output price like a PPI, or in our case, we're going to be applying this to a value-added price in the industry. And the markup is there, yes, because the producer is the one charging markup. Yes. Okay, so yes, so right at the end of the talk, we're going to do exactly that. Yes. Okay. So what's going on? It's relatively straightforward. If nominal wages go up, nominal prices increase. If real labor productivity increases, marginal cost falls, prices fall. If markups go up, prices go up. And finally, what's this term about here? This labor cost share. So that is the share of labor cost and total cost. If I fix these two terms, if I fix wages and labor productivity, and I increase the labor share of cost, that must mean that since I'm fixing wages and labor productivity, the capital share of cost is falling. So I'm able to produce the same amount of labor productivity with less capital. That means my marginal cost has fallen and prices fall. Okay, so that's what those four terms are doing. Loosely speaking, I'm going to be thinking of this as markups, these two terms as capturing something about technology, and this term as capturing something about factor prices. Yes? So, so in principle, I think they could be very important. So we're not going to have like a general equilibrium model. We are going to be able to say, I think the kind of first order thing you would imagine about, say, or the single biggest thing that happened in our sample to the sector composition is the rise of computer manufacturing in the US. What we would think of as the kind of signature, the data signature of that rise of this very productive sector is not going to be showing up in our data. Okay, but absolutely, I think interesting thing to do in the future would be to take this and think of this in kind of a big general equilibrium model. Yeah. Okay, so I'm going to apply this decomposition to the tradable sector. So the fact is, we know that prices did not diverge in these tradable sectors. So why didn't they? So the first reason, if you look at nominal wage growth in the US and Europe in these tradable sectors, so remarkably, nominal wage growth is almost identical in these sectors. What else? So the contribution of that markups net of returns to scale term is also roughly flat. Okay, so markups or the change in returns to scale is the same in the US and EU. Labor productivity growth is somewhat faster in the US. Okay, so that would, all things equal, tend to decrease US prices. That is offset by the fact that the labor share of cost in the US falls. What this means is the US is using more capital to produce this labor productivity. And of course, more capital means also higher cost, which translates into higher prices. Okay, so these terms roughly offset each other. And then nominal wages and markups evolve the same in tradable industries. So contrast that with what's going on in non-tradables. Okay, so in non-tradables, we have this very big divergence, these more than 50 log point divergence in the evolution of prices. And how does that come about? So the first thing is, it's not about differences in wages. Okay, again, nominal wage evolution in the non-tradable sectors in the US and EU is roughly identical. These are dollars and euros. These are just log changes in nominal prices. If I converted this into euros and dollars, the euro and dollar does not have a big trend. Certainly, this would be more volatile. But is there a reason that the common currency is interesting here? Probably not. Not for our purpose. Because what we're trying to understand is these producers, this is the marginal cost or part of the marginal cost they're facing. This is what should enter our decomposition. Yes. So we do a bunch of stuff, but in what I'm showing you here, we're going to follow what Barkai does in his job market paper. Okay, so the R is the 10-year yield for the specific country, and we're using the specific cost of capital deflator for each sector. So the R doesn't matter very much in the end. What matters a lot is, of course, K, right? So what we can do is, a robustness we do is we replace this measure of the user cost of capital with just a constant one. For our measure of the markups, it matters, of course, but not enormously. What matters a lot for markups is whether you think that the deflators for capital overall are much more aggressive in the US. The US builds up a lot more capital stock because deflators are telling us that the US is much better at making capital. If we treated both sectors, if we treated the US and EU at the same deflators, that would really change our measures of the markups. What it would say is the markup in the US went up a lot more than we're saying here. Okay, because the US capital stock would look much smaller. Correct. Exactly. Yes. The same R, yes. The same deflator, no. But for the same R, we do, yes. Okay. So, so nominal wages go up the same. So the nominal wage is interesting because one plausible theory is that the US has this explosion in productivity in computers. Workers get sucked in the computer manufacturing sector. That raises nominal wages everywhere, and that's what drives price divergence. That's obviously not what's going on. Nominal wage growth is very similar in both. So what is driving the divergence? So part of the divergence is accounted for by this difference in the evolution of markups net of returns to scale. So roughly a third of this gap is explained by the evolution of markups net of returns to scale. What else? Well, the remaining component is this technology. So labor productivity growth in the tradable sectors in the US is lower. That means that passes through as higher prices in our decomposition. And also the labor share of cost in the US is falling. That means that in spite of having lower labor productivity, US tradable sectors are using more capital, and all that translates into this wedge. Okay, so the wedge in GVA deflators between the US and Europe is 1/3 is this difference in markups net of returns to scale, and the remainder is this technological contribution.
Does the bottom left square with Ruiz and Demand, like the universal drop in labor share?
I don't know, but I know who does. Sophie?
There's just methodological differences that having forward sectors outside the US. And actually, the European language has been problem with that. All the US language is run by about since the 1980s or 1970s, which data was taking start. And actually, most of the divergence comes from the manufacturing sector. And actually, most of the divergence comes from the non-tradable sector. So here is a very big divergence in the range of income evolution, and that reflects the aggregate divergence in the data.
So the answer is no, I think. This is your so Sophia and Germán have a nice paper where they adjust labor shares, and this is what they find. Yeah. Okay. So this is mu over gamma. So just to think quickly, so we can't decompose into a markup and return to scale. So what would it imply? What would be true if this increase is driven by returns to scale? That would mean returns to scale in US non-tradable sectors are falling more than in Europe. Okay, so yeah. Okay, great. So to show the industry composition of these changes and to kind of make the point that these are not driven by any specific industry. So actually, I guess this gets to James's question about whether industry composition is a big deal for this fact. We have over here the same decomposition, but for non-tradable and tradable industry separately. Okay, so these gray bars, that's the differences in prices, those GVA deflators. The pink bars, that's the contribution of that markup over returns to scale term. And the cyan and yellow, that's the contribution of this, what I'm calling technology term. So you can see that for non-tradable industries broadly, the magnitudes are different, but the patterns are pretty consistent. And in tradable industries, you can see that there's no particular pattern. Okay, so this really looks like something is happening in these industries that are relatively shielded from trade. So there's some commonality in how these industries evolve over time in the US. Okay, so this was all kind of descriptive evidence. So just to show you a little bit of something more causal, what we're doing here is now focusing on the US, where we see that this wedge is emerging. We're going to be thinking about the relationship between import penetration and changes in prices and changes in profit shares. And profit shares are going to map to that mu over gamma term, that markups net of returns to scale. So this is just a correlation in 5-year changes. You can see that the correlation between the profit share, that mu over gamma, and import penetration is pretty strong, and also in prices. Okay, so this the price correlation there, or the price causation, that's something that Xavier has already shown in a nice paper. Okay, what we're adding here, we're doing this exercise at the 6-digit next level. So these are price indices and profit shares coming from manufacturing industries in the US. Okay, so to do the causal analysis, we're going to use the Pearson-Schott instrument, and we're going to find that indeed falling profit shares at the US manufacturing industry level are caused by this rise in import penetration. Okay, so beyond the descriptive data, it is the case that in US industries, as import competition increases, profit shares fall. Okay, so in the final part of the paper, yes. Sorry, so here, unfortunately, we can't do for the EU. This is really we can only do this causal evidence for the US, or at least we haven't thought of a way that we can do it for the EU. So this is really looking at the US. It's true that for the EU, all these industries are much more open to trade in the EU than in the US. So this really looks like it's more of a US specific issue. Yes, please.
That in the US, the only grocery stores that are opening are European grocery stores. So Trader Joe's is owned by Aldi, Lidl, and Train. Would it be interesting to expand the import penetration to think about these sort of acquisitions open?
So definitely. There's some nice work by Amity and Heise that does some variants of this. They're thinking about concentration in industries, but taking into account foreign participation. And definitely those things end up mattering a lot. Okay, so I think it would be interesting. Of course, retail is one of the things that we don't consider here. These are all goods producing industries, but I think that's more generally interesting to think about. Yeah. Okay. All right. So on to how this passes through into CPI. Okay, so here we're going to do something relatively simple that we think is interesting, which is we're going to be using the US input-output network to map these, what we call wedges that we identify in the data, this difference in the price evolution in non-tradable sectors between the US and the EU, see how that feeds through the input-output network of the US economy into consumer prices. So A, that's the input-output network. We have our Leontief inverse. We're going to feed through these wedges. That's going to tell us this D log P changes in prices, and we're going to be weighting those by the domestic content of personal consumption expenditure sector by sector to get at the implication for consumption. To then map that average effect into the distributional implications, we use CX and expenditure shares by income quintile. That's going to tell us what the incidence is at the income distribution level. Okay, so the wedge we're feeding through is the difference in the red lines. The difference between this red and this blue line, this we can explain through retail and distribution margins. Okay, so two things are happening in the US. One is the PPIs of these industries are increasing, producer prices are increasing. At the same time, something is happening in retail. TFP growth in retail means that CPI prices increase by less. In the exercise, we're not touching whatever is happening in retail implicitly. We're just feeding through the difference in the PPI.
Maybe you have to be better off. We have to get lower margins for retailers.
Okay, so very good. So in our kind of counterfactual, this is exactly what we're saying, that this difference in if we could eliminate this difference in the PPIs in the US, between the US and Europe, and not touch other aspects of the economy, that's how we're thinking about this counterfactual. Yes.
The other part, third said, doctor's services would be preferred on trade, nobody uses trade inputs, so they're gonna use the government matrix to back that up.
So to the extent that doctors are using some of the sectors that we identify as non-tradables, doctors will be affected by this stuff. But so, precisely for the reason I said before, we would sort of love to write a version of this paper in which we're comparing the price of doctors in the US and Europe. We'd love to write a version of this paper in which we compare shelter. But I mean, I'm not saying it's impossible, but I'm saying we're definitely very far from being able to make those type of comparisons. Okay, so the shocks, these wedges feed through, and then we look at distributional consequences. And so what's the outcome? So at the average instance of these gaps in non-tradable wedges, the counterfactual in which had prices in the US non-tradable sectors not increased by 2% per year more for about 25 years, US consumption, that represents about $3,200 per household year, of which about a third is due to that markup term. Okay, so that wedge is equivalent to about 2.2% of US household consumption, and the pure markup over returns to scale term is about 2/3%. And in terms of incidence in the income distribution, that's what these bars are showing over here. So if I show you, focusing here on the picture on the right, this shows the effect on after-tax income of this difference in non-tradable goods costs. So for the poorest quintile of households, that difference is worth about 5.5% of after-tax income, and the contribution of that markup wedge is somewhere around 1 3/4. For the richest households, that's about 1.25% of after-tax income. Okay.
This is just for your non-tradable category.
Correct.
Which are what share of the consumption basket?
So let's see. So it's food. Okay, so the truth is, because things that are intermediate inputs are in our non-tradable goods sectors, I actually can't tell you off the top of my head how the price of wood feeds through into the consumer basket. But I guess the categories that feed through directly are food and pharma. Those feed through directly into consumer prices. I'm almost certain that you know better than I do what the share of those things are in the consumer basket. Yes, but it's a very large wedge, 50 log points. So if we knock out 50 log points, that's the reason. One third of the CPI basket, says Sophie. Okay, great. So that's it. So this wedge is very large. That means it has very big implications for consumption and for the distribution of consumption. Okay, so let me wrap up and maybe finish with some kind of general thoughts on this US versus EU living standards debate as well, which is, I think these are the things that I learned writing this paper. Okay, so the first is that cross-country comparisons of living standards are extremely, extremely difficult to do. Okay, we heard a whole paper about how even inside the United States, figuring out what the price of shelter is very hard. So this paper, I think, contribution here is that we're going to focus on sectors where these comparisons are feasible, where there are difficulties in measurement, but we could get our arms around it and understand what difference there are in measurement, so we can be confident that what we showed you today is not an artifact of the data. And what we're doing here is we are isolating a narrow, but as Gabe pointed out, welfare relevant contribution to the gap in US versus EU living standards. If we could undo that disproportionate increase in US non-tradable consumption, US consumers would be better off today than they are. Okay, that doesn't say, of course, that anything more general than that about the differences in living standards or evolution of living standards. And so the takeaway here is that industries that are most shielded from international competition, that's where US prices have risen much, much faster than Europe over 25 years. Again, we can only do non-tradable goods. That's where we can confidently measure things. I guess this invites thought about whether this might apply more generally to other industries that are shielded from competition, in which measurement is much more difficult. And in our accounting decomposition, about a third of the divergence between the US and Europe is accounted for by markups, net of returns to scale, and the remainder is due to difference in productivity. And that's it. Thank you.
So we have a few minutes for questions.
Yeah, Xavier.
Dynamics within the non-credibles. So, like concentration, policy, whether the proteinates related to shocking.
Yes, so this is something we're pursuing. Yeah, so this is one of the things we want to kind of do. Yeah, absolutely. Yeah, Ricardo.
Large gap. And also further different like about how high trade costs are. You know, a 70% price gap virtually between shoes and a shoe there or whatever. Trade costs are actually gigantic. So the point is not that hard to ship things from one side to the other. Could you perhaps look a little finer in your categories to see where it's plausible that we have such enormous trade costs that would justify such a huge gap?
I mean, that's an excellent suggestion, and I think that's something we should pursue. Absolutely. I mean, yes, I think it would be really interesting to understand that. Now, the data is the data, so these price gaps happened, and I think definitely it'd be great to trace down where they come from further. Absolutely, yeah. Yes, please.
If the tariffs, everything became non-tradables, what is your prediction of the relative evolution of affordability across the year?
Well, I have a feeling that I think firms are very responsive to incentives. Oh, sorry, what's happening to antitrust on the other side? I guess that's the question. Who's in charge in DOJ and stuff? To the extent that trade and antitrust enforcement are kind of substitutes, I guess the question is what would the DOJ do? But yes, I guess if everything became non-tradable, we would say that over time, we would see very big increases in prices. Yeah, I think that's definitely something we would say. Yes, please.
Say that calling your bread today, that was calling bread 20 years ago is very acceptable. And even if you go fruit and vegetable, my husband tells me that my in-laws, when we first came to this country in the 70s, they have to go to a fantastic grocery store in order to get ginger. But today, you walk into Whole Foods and the array of herbs and so forth, just pretty astounding. And so I don't know to what degree does for agencies are able to think that into account. So I mean, having better data try to account that. There could be some kind of interactive effect in the sense that the people who are willing to pay, some markup for the high quality food, probably increase and the markup.
So the BLS does precisely this, right? They want to adjust for the fact that sourdough is much better now, right? That's what quality adjustment in the PPI is. It's just that quality adjustment is overwhelmed by increases in prices. And no, completely. And so what we should do is we should do surveys like what Gabe did and ask people, how do you feel about bread today versus 25 years ago, and kind of try and pin down the real hedonics of bread. Yeah. Yes.
A lot of work on right? So if you're taking a ratio of two things that arguably are changing in quality of similar. So before you do the imputation, check them off on price conditions on top of it. And then if there's a quality adjustment that's heterogeneous in that treatment, then you know there's going to be a measurement issue.
Yeah, definitely. Okay, so I think that in general, we need better data so that we can do, especially cross country, right? I'm not aware of anyone who has. Ooh, sorry, I'm breaking your lecture theory here, guys. Okay, this is for you. Okay. Yes. So one thing we're planning to do is to use cross-country scanner data to try and get at some of these things. That's something that's on the menu. Yeah.
Okay, we should probably break now. Let's give Josep another round of applause.
They don't matter. They're,
For some reason, it keeps on spinning. It went like all the way around last time. Hopefully that stays still. And I clicker. It'll be great. Oops.
Okay, let's get started again. Saki is going to be presenting the third paper of the afternoon. Take it away.
Okay, thank you so much for putting me in the program. I view anyone who did an undergrad in economics somewhat of a survivor, in the sense that you're like, in my case, I'm 17, like hormones are bouncing up and down, and I show up in my first Econ 101 class, and first thing I'm taught is the demand for bananas, with quantities of bananas moving and price. I couldn't think of anything more boring or more dry. And the topic of this presentation is something even drier, which is the demand for reserves. Things get exciting only for the trained economists who now, after studying other areas, can think of the ramifications. So this is what this paper is about: demand for reserves. It's joined with Luis Yepes, who's a student in Chicago, who's hiding there in the back, and Pablo de Erasmus, who works for the Philly Fed, so the usual disclaimer applies. So let me give you some motivation. So in monetary economics, the demand for some type of money plays a central role. In particular, for a long period of time, monetarist economists have studied the demand for non-interest rate bearing assets to think about the relationship between inflation and the holdings of monetary assets, to think about price level in the long run, et cetera, et cetera. Of course, there's been debates whether there is such a thing as a stable money demand, and for a while, this program was abandoned. More recently, there's been an increase in interest in studying the demand for a different type of monetary asset. Is the demand for reserves by commercial banks. It's been less studied, and it's recently having a revival. And the reasons why understanding a good or having a good understanding of the demand for reserves is important is because it has implications for how we implement a federal funds rate. This is something that's being discussed right now all over the world. It's being discussed even furthermore in the US right now with Kevin Warsh. It is also important to understand what are the effects of balance sheet operations of different instruments, and what's going to be the elasticity of the response to the federal funds rate if you do one or the other operation of a central bank. And there are other ramifications if you think that the federal funds rate is connected to other spreads, say, for example, the corporate spread. And that's when you start thinking there are other ramifications for macro. So conceptually, how do we think of the demand for reserves? We think of the demand for reserves, and I'm going to come back with a little bit of theory in a little bit. We think of it as a sigmoid function. We don't think of it in the standard way of thinking of it just a straight line where we have like price and quantity moving linearly. We think of it as a sigmoid. And the idea is that there are typically two rates that cap potentially the prices at which the demand for reserves can trade. One rate is a discount window rate, and there's a floor, which is the interest rate on reserves. It could be zero. And so this demand will shift as a sigmoid around it. And the quantity variable, the relative quantity variable that we we associate with this market is the ratio of reserves, M in this case, relative to a demand for reserves scale, which could be deposits. I'm going to come back to the theories. If we want to estimate the demand for reserves, we would confront some classic and non-classical problems. The first non-classical problem would be that it's a nonlinear object, if we believe the theory. Second, you have the classic simultaneity problem of estimating demand and supply, and that's what the sketch in the right is trying to show you. Third, this is not like a market. It's not like the market for oil, where you can have a weather shock or a war in the Middle East, and that's a good supply instrument. And the reason is that you have a player out there that is trying to move to smooth price movements, and that's the Federal Reserve or any other central bank. So you have endogenous response of supply to demand conditions and to potential shocks to supply. And finally, you also have a Lucas critique. Is the idea that, if the Fed commits to a certain rule to respond, potentially the precautionary demand for reserves will shift. And so you have all these challenges. And the literature has, of course, been aware of these challenges and conduct certain technical procedures to avoid those challenges. So in particular, a very first paper on estimating demand is one by Jim Hamilton from the 90s, a beautiful paper where he uses innovations in the Treasury General Account as supply shocks in the market for reserves. He focused on a narrow period from 1989 to 1991. And I asked Jim, I was very excited when I first read it, and I asked him, why did you stop? And he said, well, because at some point the Fed started responding to movements in the TGA account. And I'm going to show you some pictures. And so it ceased to be a valid instrument. Later on, like years ahead, I was very stoked to see Annette presenting her study on demand, because a demand for reserves has been an input for many of my theoretical papers. So again, she focused on the post Great Financial Crisis period using nonlinear least squares, and then there's other papers using VAR identification and structural models out there. So the contribution in these papers is rather modest. I'm not going to make a huge innovation, but I think we need to, continue working on this area, because we need to build a body of work to understand this object. And so what we're going to do here is try to extend the analysis going all the way from 2003 to 2023 as an estimation period. Methodologically, what we're going to do is we're going to try to combine also historical analysis going further back in time. The historical analysis will be a motivation for why this is important, and it will be a motivation for why we need to think very carefully about institutional details, about how monetary policy is implemented, to know when to break your samples into different periods that correspond to different policy regimes. And I'm going to give you a structural reserve demand estimation and an IB estimation. And another thing that is rather novel from our model is that, or from our paper, is that we have confidential data on bank level growth rates of deposits, which, according to the theory I'm going to show you next, is a proxy for demand shocks. In particular, we're going to observe the entire distribution of growth rates of deposits. So our view of the world is that when there's a shift in the distribution of deposit growth rates, that will act as a demand shifter, a demand shock in a particular period. So these are the innovations. So let me start with some theory just to motivate why we think the demand for reserves is a sigmoid. I'm going to go back to an old model by Poole. It's actually a model that the operations offices or departments in the Fed or the ECB actually use to think about the demand for reserves. So the primitive of the Poole model is a shock to deposit positions. So each bank faces a withdrawal, potentially a withdrawal of deposits, omega, distributed according to F, a distribution F. It's a no. It's trying to capture payment shifts. And banks are holding reserves M, and they're issuing deposits D, and potentially have to satisfy a reserve ratio rho. So the balances of reserves at the Federal Reserve of an individual bank would be what you see in that first equation, which is reserves minus the potential deposit outflow minus the reserve requirement, the required reserves after the withdrawal. So that's going to induce a distribution of balances. And the key idea in the pool model is that that after your position is determined, you have to satisfy positive balances of the Federal Reserves. And you can do that in two ways. You can do that either borrowing from the federal funds market at rate F, or sorry, at the quantity F, or borrow from the discount window W. And those funding sources have different costs, okay? But the idea in the pool model is that you borrow at the federal funds market before knowing your shocks. So what you can do is you can stick it in any model of banks with any portfolio returns. And you would have returns on a ton of other assets, potentially here. But from the perspective of computing what you're doing with the interbank market and borrowing from the discount window, you would have these extra two terms. One is how much you borrow in the federal funds market, and the second is how much you borrow from the discount window. And the idea is you would borrow from the discount window whatever you don't have borrowed from the interbank market, and what's your remainder after your shocks are there. So you borrow only the tail of large shocks. And if you take first order conditions to the holdings of interbank loans, you would find this relationship. And that's how you recover this sigmoid shape. It tells you that the spread between the federal funds rate and the rate of reserve relative to the spread between the discount window rate and the rate of reserves, what I'm going to call the normalized federal funds rate, is actually a sigmoid function if your distribution F is actually single peaked, okay? And it's a function, these prices are a function of the ratio of reserves to deposits. How well covered are your deposit outflows, potentially with your reserves. So this object is a normalized spread, and this comes out of assuming just symmetry in the initial positions. But the pool model is somewhat primitive in the sense that there's no trade it prices the federal funds market, but there's no trade. And there's been recent theoretical innovations to get a bit more of mileage out of this model. So this work started with Garafonso and Ricardo Lagos, thinking of the federal funds market as an over-the-counter market. And the idea is that you have an entire distribution of banks with surpluses and banks with deficit, and they're going to trade in an over-the-counter market. So this over-the-counter market is going to work like a search market. And banks are going to make phone calls to one another and saying, hey, are you short of reserves? Do you want me to lend you some reserves? Do you have any extra reserves? And it's modeled as a sequence of markets. Yes.
So since 2008, my understanding was that there basically is no trade in the federal funds market. So should I really be thinking about the repo market here?
So that's not precise. That's not precise. I mean, there is some trade. You can go to New York Fed and you'll find some volume.
Federal home loan banks.
Home loan banks and the
Right.
international.
Well,
Another way of saying,
well, no. I wouldn't say it's the only. It's a lot of it, and that's gonna happen here. That's gonna happen here, and the result of being in that scenario is that you're gonna be very close to the interest rate on reserves, or even very close to whatever the outside option are for those institutions.
let me repose my question.
Yes.
The overnight repo market is $4.5 trillion per day. And the federal funds market, including all these federal home loan banks, is $100 billion a day. So it's 45 times smaller. So it seems like the real money market today is the repo market.
Fair enough. And let's consider the repo market as part of this. Let's consider it as part of this. And if if it's something that that essentially vanishes the market, we should allow for it. And I'm going to show you that you can allow for it and still recover that sigmoid shape. Yes.
What's happening currently, the people market volatility picks up right around the point when the reserves start becoming scarce. So in that sense, that's why there's still so much focus on understanding the trade market. I think part of it has to do with the game, with stuff like around treasury options, the dealers have to get repo funding to hold the stores for a few days. But how hard it is to get that will depend on whether there's sort of a reserves in the system. So the two markets are linked. But you know, like the Fed has models also now for repo that has additional variables like money market assets and that sort of.
I mean, it's an important point, and what we want is also understand when is it that the federal funds market basically has no trade, and what's that threshold point, and that's going to show up not in this slide but in the next one. Ricardo.
I mean, a year ago, we were writing a search model, made sense, because we didn't have the data, but now we know that there's all the boring direct market, both the Lagos Navarro data, that comes from 3 or 4 banks only. So there's no calling around anyone. Everyone calls the same 3 or 4 banks. That's all fun. I mean, the Lagos Navarro is 92% or something all. So we really want to think about it as a metaphor for bargaining and trading, but thinking about this as a search market, actually data in the AP and in the Lagos Navarro.
That's fair. The Lagos Navarro is a search market with big and small. You know, it has a lot of extra. Okay. This the point of this is to come up with a very simple formula for that sigmoid function that gives you extra predictions. A prediction about volume that I'm going to show you works well, and predictions about dispersion of rates. Of course, you can go always deeper and deeper into the theory. I'm on board with all of this. Okay, but so the idea is to model sequences of trades, and these sequences of trades are evolving across n trading rounds. This is like breaking the time of the trade of the federal funds market into different bins of time. And the advantage of the first iteration of these models was to precisely obtain these trade volume and distribution. Okay, but the problem is that these models are, you need to keep track of positions of reserve surpluses and deficits among big banks and small banks, and the identities of players matters, and so they're super complicated. Okay, so what we've done in earlier work with Javier Bianchi is to find a model that captures a lot of these features, but that gives you closed form formulas that are easy to interpret, that you can put in a computer, easy to estimate, and then easy to connect to things like volume and interest rate differentials. Okay, so how does this model work? It's exactly the Alfonso Lagos model, translated into continuous time, and assuming that trades are small. That when two banks negotiate for a rate, they don't negotiate the entire position of a bank. They negotiate small bins of trade. And what you see in the data is that they negotiate over bits of $1 million. And what are the inputs of these models? Is exactly the same thing. It's a distribution of that you saw earlier in the pool model. It's a distribution of reserve positions, and you take all the banks that are in deficit and you take all the banks that are in surplus, and you construct something like a market tightness. So this data represents how many banks are short of reserve relative to the banks that are long of reserves, and that's the market tightness. You can think of it as in the exact same way as a labor market, with vacancies to unemployment, but this is for the market for reserves. And it turns out that this model has a simple ODE depending on the matching function gamma, and it has an efficiency parameter. And so this ODE will capture the trade in the federal funds market. You can track in one trading session how the volume will evolve. Furthermore, you don't need to see the details here at the top. What this model will give you is, given the initial condition for market tightness, tell me what this parameter is, lambda, the efficiency of the market, and I can tell you what how tight is the market at the end of the trading session. So a special feature of this model is that if your trade is sufficiently efficient, or your initial condition, alpha, which depends on how unbalanced the market is such that, for example, you have a ton of reserves, very little deficit relative to the surplus, the federal funds market would clear very quickly and there will be very little trade. No bank will go to the discount window. When the market is tight, when this market tightness is close to 1, it won't trade entirely. It won't settle entirely within banks, and some guys will go to the discount window. So it shares that feature. And that depends on the volume, and that depends on how unbalanced the market is to begin with. So scenarios where the interest rate on the federal funds market touches the floor of a corridor system are scenarios in which you have sufficient surplus of reserve. Nobody borrows from the discount window, and the market trades very quickly. One extreme scenario is that you have so many reserves that nobody needs to trade. And maybe that's what you had in mind, John. But that's also possible here.
But so my understanding of the current situation is that I'm going to think about this in terms of the repo rate. The repo rate starts shooting up even when like reserves are $1.5 trillion or something. So there seems to be,
Noise.
it's not really about zero. It's about everybody has enormous demands for reserves, enormous positive demand for reserves. Is that part of the model?
One thing is to have a demand for reserves before shocks. This is the market after it has traded. So there's demand for the federal funds, for federal funds trade, and there is a demand for reserves behind the scenes. So the reserves have to be held in equilibrium by banks. So that's behind the scenes. So if everyone is flooded with reserve, then the payoff, the value of reserves has to be such that the expected return is just the overnight rate.
Let's say there's just a big shift to the right in that reserve because of regulation. But we my hands for regulation because they don't have many. What parameters that has to be? You need to have something that shifts demand towards the right. Which again, I can give you or you can read the paper for all of these reasons why it shifted to the right. So how is that going to be here so that I can see it?
You're going to see it in a few slides. So I need to tell you, there's going to be a liquidity demand by banks that shifts it. There's the efficiency of the market, which also has effects. And there's the shocks to the distribution of positions as well. So I'm going to come back to that. The point up to this slide is just to observe that just like the pool model, you're going to have a sigmoid function for the federal funds market that is a function now of the market tightness, which depends on potential shocks, which depends on how the market trades, and which depends on bargaining coefficients that also show up here. Later, I'm going to estimate this, and I'm going to tell you what I'm going to show you that. Yeah. But anyway, quickly connected to this point, if the market is sufficiently slack, then you will touch the floor of that corridor system, and it preserves that sigma rate.
It feels like that'd be okay for you. Or is it when you take it to the data, you're actually going to match the Fed funds volume for the volume?
One scenario is, let's interpret this floor as the overnight repo rate, and the trade happens including non-banks. So let's collapse all repo rate trades and interbank trades as one market. The reason why I'm reluctant to say I want to get married to that answer is because there are institutional details that matter, but this model won't go in that depth. Yes. Second. Yes, there will be a common shock, which is the shock to the distribution, which will be common, and there will be a policy I agree. Yeah. Okay. So before I estimate this model, before I give you reduced form estimations as well, let's talk a little bit about history. History motivates us in thinking about a few things. So we have data on the federal funds market from 1959. And in the paper, we discuss this earlier era, which is not part of the estimation sample. And that's the purpose of that is to give some context. So we have the Bretton Woods era, and I'm going to split it into two. I'm going to explain why. And then we have a post Bretton Woods period, a period where you had stable monetary aggregates, and then a period of declining monetary aggregates, and then we have the modern era. So again, think of the liquidity, the quantity variable as, and this is going to be the variable that we look throughout the paper, is as a ratio of cash. So that includes reserves, vault cash, and treasury holdings relative to deposits. So that's our liquidity variable. And then think of the price variable as exactly the object that I've been talking about. So those are the counterparts. Have that in mind. We have weekly data for this ratio from some tables published by the Fed. So the first thing I want to show you is a historical plot of the federal funds market and the discount window rate in orange. And later on, an interest rate on reserves is activated. What I find super interesting about this plot is the Bretton Woods era. So think about this period in the early 50s all the way into 1955. You have the federal funds market being extremely volatile and hitting the ceiling of the federal funds or the discount window rate very often. There's a reform in 1955 by the Fed, and suddenly the federal funds market starts trading frequently and for a long time, for decades, way above the discount window. So it seems that for a long period, this market did not have that ceiling. So that's one important takeaway, that oftentimes you will find situations where that ceiling applies, and there are other situations where the ceiling does not apply, and it's very unstable. We talk a lot about secular decline and stabilization of volatility in many markets. Like when we talk about the great moderation, we never refer to this plot, but this is a long period where shocks to demand in the federal funds market was not stable. Second thing I want you to take from that previous plot is that the supply of reserves by the central bank was very stable all the way until the Volcker era, and then suddenly it declines, but it also starts moving way more in a way more volatile way. You put the two pictures together, and you see this thing that I find beautiful. You see the federal funds rate loses a lot of volatility, and the volatility is soaked up by the quantity variable. And I think it's super interesting in terms of thinking how money the money supply responded and stabilized rates. This picture here goes back to the two objects that we want to compare. So the two objects that we want to compare are, again, the liquidity ratio in red, and then in blue you see this normalized federal fund rate. And so you see another thing that is problematic for us, which is that there are these huge jumps in the liquidity ratio that clearly indicate a change in regime. So that tells us that you have to cut the data in different periods in time differently. A, because you have different volatilities, and B, because you have these huge increments that take you all the way to a different position. This point is what John was alluding to. If you zoom into the earlier era, for a long time, we didn't have an interest rate on reserves. And then after 2009, we have the federal funds market trading below the interest rate on reserves. That's because they're trading with non-bank institutions, and the relevant rate is the overnight rate on reserves. So if I want to think of a theory that connects to this corridor system, I have to think of a different rate that's not the rate on reserves, and that's one way to interpret Arvin's comment. Okay. Another thing that you see is that there's been huge changes in the policy instruments. There was very little movement in the Treasury general account, so it was not such a a great source of variation to work with exogenous variation. But the instruments have changed a lot. So another reason to think of regimes. And finally, this is another picture that I find interesting that we explored in the paper. You have here a plot of the daily, on the left, the daily standard deviation of cross-sectional deposit growth. So this is a massive amount of deposit outflows that happen at a weekly level. The average time series standard deviation between week of deposit outflows is now with this data that Pablo has access to is about 1.5% of deposits every week. So the average outflow and inflow is about 1.5% of deposits every week. 1.5 may not sound a lot, but it is a lot if you think that banks are highly levered institutions. One thing I want you to take away is that the volatility of deposit flows was higher before the recession. Something happened and the deposit positions were much more stable. After COVID, it bounced back. Okay. So let's go back to structural model fit, and then I talk about the reduced form estimation. So let's recall that model we just described. So the first step in this model, so to construct this normalized federal funds rate as a function of a quantity of reserve lambda relative to deposits, you need to use 3 steps. Ricardo, this is where your policy comment comes in. So first, the market tightness is the ratio of deficits, banks in deficit to surplus. That depends on this policy parameter rho. That's like the reserve requirement. You can think of liquidity coverage ratios. Second, it will depend on the sigma. Sigma can be a projection of the distribution of outflows. So you can think of this as just, on average, a binary shock that takes some money out of your bank and brings money out or money into another bank. So this ratio is the ratio of tightness. So give me the tightness, give me the efficiency of the market. I can give you this theta bar, that's the terminal tightness, and that's enough to price the federal fund rate. It depends also on bargaining. So related to the question of what is the relevant interest on reserve, that's the way I think about your earlier question. So what's, how is the interbank market trading? If you plug in directly the rate on reserves, you're going to have the problem that the federal funds market was trading way below the rate on reserve. So the rate on reserves cannot be the relevant floor. So the way to think of that question is, I'm not thinking of the details of the market. I'm not thinking, that they're trading because of arbitrage. I'm treating as it was just, trade due to these inflows and outflows. But I have to think of the floor as a floor that is adjusted for.
It seems to me that your model just maps much better into the repo market. You should be thinking of ONRRP as the floor and whatever it's called, SRF or whatever it is, as the ceiling, and then thinking about a repo rate as the thing that is in this corridor.
That's de facto what we're doing.
But then the data should also be that, right?
And it is that. So what I'm doing is I'm subtracting from the interest rate on reserves, these amounts that give me something very close to
but the market rate you're thinking about should not be the federal funds rate, but should be the repo rate, I think.
Well, there is. Are you saying they trade at different rates, and so?
I mean, you're thinking about the interest rate in the money market in the United States, and I don't know. One view is that the relevant, corridor is the repo corridor that has been created by the Fed by now, and the relevant rate is the repo rate.
Okay, point well taken. So I should find a broader measure, and potentially the rates are different. Okay, good. Okay, so we go back to our estimation. So what we do is we minimize the square errors of this sigmoid relative to the data. And so because of the historical motivation, we break the sample into three periods. So we have the scarce regime, post great financial crisis, and post COVID, which I'm lumping together, and I'm truncating the data 2022. If I go further forward in time, I get garbage. one of the things that you observe is that the parameters are changing, but they are changing in ways that has an interpretation, I think. So one is, you can see this sigma dropping over time, and that's consistent with the volatility plot of deposits that I showed you. Second thing you observe is that the efficiency of the market also drops. I interpret that as an indication that for a given volume, banks are trading less. And in particular, the moment where this is more salient is right after 09 and 10, where you really need the efficiency to drop to explain the discount window rate borrowing. And I interpret it as trust, as a declining trust among banks. The bargaining parameter is also changing and is shifting toward borrowers. So that could be a reflection that there are other trades, precisely the ones that we've had talking about, and the model needs it to produce a lower rate on the federal funds market to explain the patterns. And finally, you have an increasing liquidity buffer from before and after the crisis. So this is something that the model spits out. How does it perform? So this effort in doing a microfounded model is to have a situation where you can actually hit the floor and the ceilings in this market. And so what you see here in the scarce regime is that the model does a pretty nice job matching the data points. You re-estimate them for the post-financial crisis, and you get this different sigmoid function. It also does a pretty good job. The R square, I'm going to show you in a second, is pretty good. And then in what I call the COVID regime up to 22, it also does a pretty good job. You get a pretty bad fit ex post after that. So this is just showing you, yeah? So what we see is that you have an increase in a substantial increase in the federal funds market for the same level. So the model needs to generate an adjustment somehow. So the normalized federal funds rate started trading up for those 2 years. Yes. So, the yellow. So after COVID, it's because it's essentially the data is flat. So it's hitting a floor consistently, and so it's actually not identified because you have a floor. Yeah.
It's not on the same, but it's line is totally different. This is visual effect first of all, I'd say.
It's because the owner, we say, is so large, so that the Fed funds rate is 7 basis points under IORB years in a row.
Yeah, and the data points are flat even. So I think it may be connected with the fact that there was very little volume. So then they were inputting the volume. Okay. Yeah. Anyway, I don't want to run out of time. So let me show you more. So this is just the exact same plot in time series. So I'm not doing anything here. I'm just, sticking inside the liquidity ratio and let the model with the estimates spit out the relevant normalized federal funds rate. And you see that the model delivers this fit. We put this extra effort to get extra predictions. So this one's the discount window rate. The reason why I gave you that complicated formula is because I also want scenarios where there's very little trade in very little borrowing from the discount window, and you can get that with this richer matching function. So the model does also a nice job predicting discount window borrowing. It cannot explain certain episodes, say, for example, at the end of the post-crisis, where the federal funds rate started trading higher because the Fed was doing quantitative tightening, and the model because it's estimating on the full sample, the model requires a little bit of volume that you don't see. Okay, so I think this is does a good job, but still it's not subject to endogeneity supply and demand. The fact that I have a structural model, and it doesn't make me immune to that. So we also do an analysis with instrumental variables. And the headline message is that you can also find downward sloping demand. And the way we're going to do this is by doing the following. So we're going to estimate a process for the TGA, for the TGA's account, which the literature has used as as an instrument. We're going to take the innovations to the TGA account as the instrument. We're going to input the innovations into Fed rules for different assets. And then we're going to take, only after parsing out or orthogonalizing the responses of the Fed rules from the TGA innovations, do we run a two-stage least squares for an IV identification. So again, this is the TGA account. We start with an AR1 process for the TGA account with controls by date and quarter of FOMC meetings and quarter. And the variation in the TGA account is what we're going to take as a supply shock. We're treating this as something that is unpredictable. Of course, we have a problem if we can predict better. Then the issue of you cannot stick it directly to two-stage least squares. You cannot take the instrument directly because the Federal Reserve is responding also to the TGA account to smooth positions. And it's responding with multiple instruments. So if you don't consider the multiple instruments, the multiple response of the Federal Reserve, of its balance sheet items, you're going to get a lot of noise and you're going to lose the signal from the instrument. So what we do is we estimate these Federal Reserve instrument rules. So we have J assets and the reverse repo rate as the only liability. And we estimate a VAR for this object, where you take also the shock to the TGA account as something that the Federal Reserve will respond to. And then only then do you instrument the change in the liquidity ratio by plugging in the shocks to the TGA. But because you've introduced these orthogonal shocks, you're capturing the secular movements in the endogenous response of the Fed in an orthogonal way, in a way that once you estimate this hat for the liquidity ratio, you can recover the demand slope. Okay, and this is the right way to do it econometrically if you think that there are other endogenous objects that are responding. Okay, so you go to the first stage, you find F stats that make sense for all of the periods. And then you find these the second stage regression fits. So these objects here represent the demand slopes for the market for reserves. Okay, and you find this negative relationship, it's steeper during the crisis. And you can take those slopes, and I can go back to the three regimes that that the model identifies, and I can figure out, well, did my structural model was my structural model polluted by identification problems? And the answer is no. That you recover the same slopes. Okay, so give me a few seconds just to explain why this matters. I mean, this nerdy topic of estimating demand matters because the federal fund markets, spill over to other markets. So within the same model, I can take the spread between the AAA corporate, commercial paper, and the model will produce me a spread. This is a different spread. It's of course going to move with the federal funds market, and you get a very sharp prediction for that market. Of course, the market goes crazy at the end of the sample, but that's because there's a potentially risk premium. So these spreads show up in many other markets, and so I invite everyone to think about this demand and to think whether there's some return to monetarism if these quantities matter.
Great. I think we have a minute or two for additional questions. So I guess I can ask another question. So in the structural model, there's this sigma that sigmoid, I guess it's called.
Yep.
That assumes that the ceiling is actually binding, but you know, the Fed has had trouble with that. You know, like, for example, in September 2019, you know, the rates shot way,
Yes.
and now I'm talking about the repo rates again, shot way above the discount window rate. So,
And it was further, I mean, it was much worse in the past.
yeah, that's a different regime where the discount window was like a discount, but yeah, even in the current regime where it really was supposed to be a ceiling, but it doesn't seem to operate as a true ceiling. Is that, I guess you maybe are never in that range that it really matters for.
No, you enter that period in that period. I mean, there's one, a couple of weeks and the model just says, I cannot take that as, the ratio can't be above 1. And the model just gets you a big residual at that date. The way to think about it is that you need an extra layer where you say, in reality, the actual discount window rate should be something like the discount window rate plus some risk premium or some extra penalty that captures stigma that can turn on and off over periods. So in other work, we throw that in. Look, it's not a universal model of the federal funds rate. I mean, there's more institutional detail that we can cover, but I think it's useful to have something simple as a starting point and to ask your question and improve over that.
You talked before about the range, the 5.1 ceiling. Maybe in our sample, which is the post GSC, we basically have censoring at the floor. If you switch to a machine like the Bank of England, where you had a lot of takeoff at the standing repos, not just on core ends and stuff, then you would have a sort of two-sided centering problem, which is something you can estimate. The reason that they don't get into that is because once you take a sigmoid, you should not think about it as reserve demand. You think about it as the equilibrium outcome. And so it's not that the true reserve demand has an odd shape, it's that the market equilibrium given the point ceiling ends up having this shape. Instead of having sigma, you can just have like a normal demand function and you have centering, which in practice works.
So I think about it differently. I think that you have demand for reserve and the demand for federal funds. And what the sigmoid is telling you is that this is the shape of the demand for federal funds. And the demand for reserves is given by the rate on reserves, the real rate on reserves. So if something is off in that market, then it shows up as inflation.
Okay, let's give Saki another round of applause. And I think it's Diego that's presenting the last paper of the day.
Very good comments.
Yes, no, I understand. Sorry, I know it was late. Just been put into NBER 2000 now operation. No, it's very. So you might look at that because I mean there was this right where a quarter system that's a big. It's a new thing for that era. Which for us, yeah, this lecture. So here's a beautiful paper. About that. But the original
Great. First of all, thanks so much to Emmy and John for including us in the program. It's been a fantastic week. And thank you all for sticking around until the very last presentation. I'm super excited to present this work on the macroeconomic effects of tariffs, insights from 180 years of US trade policy. This is a joint project with Tamar Den-Besten, Regis Barnishaw, and Ayush Singh. And Tamar is also here today. She's a fantastic PhD student at Northwestern University. And because some of our co-authors are at the Fed, the usual disclaimer applies. So this is not the views of the Fed on how tariffs affect the macroeconomy. So the the last couple of years have been pretty turbulent times for trade policy. The sharp rise in US tariffs last year has sparked renewed interest in the question of how tariffs affect the macroeconomy. And many people also in this room have started to reconsidering this question again. While there is burgeoning literature that studies the local or sectoral impacts of tariff changes, there is surprisingly much less direct evidence on the aggregate macroeconomic effects of tariffs. And the little evidence there is also largely focuses on the post-World War II experience. And as you all know, this was a period of pretty stable and relatively low tariff rates. So it's quite different from the current episode. And the few tariff hikes that we experienced in that period were also often enacted in response to economic developments. For instance, the Nixon surcharge, which was basically a direct reaction to the balance of payment problems that the US faced in the early 70s. And this is also illustrated in this chart. So here you can see the evolution of average US tariff rates over the post-World War II period. And you can see, if you look at the dutiable tariff rate, which is the blue line, after the war, this was around 10%, and then this was reduced in subsequent decades and reached a level of around 5%. Then there was a stark reversal, right? So when Trump was elected for the first time, tariffs increased the first time in a while. And then this was followed by a subsequent hike last year after Liberation Day. And when judged against this recent historical experience, this was really an unprecedented increase in tariffs. Interestingly, though, if you go back further in history, there was a time in the US where tariffs were much higher, and there were also large swings. So basically, here you can see basically how tariffs evolved before World War II, and you can see the level was higher, was around 40% if you look at the dutiable tariff rates. And there were also large spikes, and many of them were driven actually by political or ideological conflict, which was what's going to help us a lot for identifying these effects. So that's great. But we also think, like from an external validity perspective, that this previous variation is actually very informative and perhaps more informative than the more recent period to learn something about the impact of tariff changes. So this was the motivation of the paper. What do we do in this paper? We provide a detailed historical account of major US tariff changes since 1840. We conduct a detailed narrative analysis using authoritative sources on the history of tariffs in the United States to identify a set of tariff changes that are plausibly exogenous to current and prospective economic activity. And using these exogenous tariff dates, we will then construct a narrative tariff shock series, which we will use as an instrument to estimate the dynamic causal effects of tariffs on the US economy. Let me give you a preview of our results. We find that tariffs have meaningful effects on both trade and US economic activity. After an increase in tariffs, we find that imports decrease significantly and persistently. Exports also decline, but only with some lag. The terms of trade improves and the exchange rate appreciates slowly. So like in terms of signs, this is basically what you would expect from most trade theory. We also look at economic activity. So what's interesting here, we find that overall manufacturing production actually declines significantly as well, despite the protective intent of tariffs. And we also find that these economic consequences are more broad-based. So we also show that real GDP also falls significantly. In terms of magnitudes, the effects are considerable. So we find that an increase in the dutiable tariff rate by 1 percentage point on impact leads to a fall in real GDP at peak by around 0.9%. How do tariffs propagate to the US economy? We find evidence for both demand and supply channels. So we show that real wages fall after these type of shocks. The price response, like GDP deflator or consumer prices, turns out to be a bit more nuanced. So in our baseline sample, which spans a period from 1860 to 2024, we find that prices increase somewhat, but the response is not super significant. And also turns out that this response is not that stable over time. So it varies a bit over different samples. And we have some suggestive evidence that points to an importance of differences in the monetary reaction function, as well as the degree of retaliation and reciprocity across these sub-periods that are consistent with these differences in the price response that we observe. What we also show in the paper is that the narrative analysis that was really, really labor intensive, and Tamar helped a lot with this, actually is crucial here, because if you were just to do the naive thing, so basically you assume that tariff changes are predetermined to the US economy, and you simply regressed, say, industrial production on tariff changes, you would find very different conclusions than if you basically use our identified plausibly exogenous tariff events as an instrument. Please. Yes, so the other ones, there are also differences, but they're more quantitative in nature and not qualitative. So for prices, we even find qualitative differences. So the sign can even flip. For the other ones, that's not really the case. Yes, so I will tell you more about this, but yeah, exactly. So actually, there is more retaliation. We find a more immediate effect on GDP, and that's because exports basically fall more immediately, which is not the case in the period with less retaliation. Yeah, so that's true. So again, yeah, it differs, but it doesn't flip the sign. So that's what I meant. But there are also other meaningful changes consistent with what you would expect, I guess. So in the interest of time, let me not spend too much time on the related literature, just because the Romers were here on Wednesday. I was a little starstruck. We really build on their approach and port this basically to the study of tariff changes. And we were actually surprised, like when we started to work on this, we basically looked at the literature and we were surprised that nobody had done this, because it seems just such an obvious application for this approach, and also turned out to work pretty well, at least in our view. And obviously we connect to other strands of the literature as well, which I'm happy to elaborate more offline. Great, so after this brief introduction, let's jump into the paper. And let me start by giving you a bit more detail about the history of tariffs in the United States. So according to Irwin, the main purposes of US trade policy can be classified into three categories: revenue, restriction, and reciprocity. And this also broadly aligns with different periods. So basically, before 1860, the main purpose of tariffs was to raise government revenue. This was followed basically by a period where the main purpose was restriction. So there was a protective intent to shield domestic industries, even though this was pretty volatile, as we will see. And then later on, basically after 1930, there was this period of reciprocity, when basically there was this belief and more also bipartisan agreement that trade liberalization is a good thing. So then, like in coordinated rounds, tariffs decreased across the globe. Until 1934, the Congress actually held exclusive authority over tariff legislation. And what's interesting in this setting is that there used to be a strong partisan divide on tariff policy. Democrats, their main constituents were agrarian exporters in the South. So they were strongly in favor of low tariffs, basically only the tariffs needed for their revenue that they needed at the time. Whereas Whigs and later on the Republican Party, their main constituents was the industrial North. So they were in favor of high protective tariffs to basically shield the domestic industry from foreign competitors. What's also interesting is basically before 1934, to pass tariff legislation, you really needed a unified government, meaning that basically a party needed control of both chambers as well as the presidency. This changed in 1934 when the Congress delegated negotiating powers to the president with the Reciprocal Tariff Act, RTAA. This is subject to renewal, but it's still the case today, as we see. The president has a lot of power in setting tariffs. And as I mentioned, basically following this, because the strong partisan divide basically waned a little bit, so there was more bipartisan support for reducing tariffs. There was the belief that basically export growth was really important for US prosperity, and obviously there were also foreign policy considerations because the West wanted to contain communism, therefore build sort of a new trading order that relied more on international cooperation, basically reducing these barriers. Great, so this is the context. Now let me give you yes, please, Michele.
How big they were, both in terms of percentage of government revenue and percentage of GDP, and how close this is to today? Also in terms of
yes, no, I mean, we're going to study a very long sample, so arguably there was structural change over the time. I mean, the tariffs were pretty high, but you're right. I mean, the government at the time was also quite a bit smaller. What's interesting though, if you basically look at the share of imports over GDP, that was relatively stable. I mean, in the more recent period, maybe increases to 10%. Before it was more around 5%. But yeah, so I think that's interesting in terms of the exposure. Obviously, the composition changed a lot because now we have more services. Before it was mostly agricultural good and manufacturing.
The percentage of GDP, what currently the liberation is comparable to the bank is a lot of percent.
Well, I mean, it's hard like to make this. I mean, I don't want to over extrapolate from our estimates. Obviously, this is historical variation. We think along many dimensions, this is more representative of the tariff policy we have now, but obviously there are differences and limits to external validity. Sorry? Yes. Yes, so in the early period, basically, they were the main source of government. I mean, the government was smaller, but that was basically the main source. And then 1913, when the federal income tax was introduced, then basically it became like slowly less important. But basically, until then, they were really the main source of government revenue. So it was important, yes. Yes, but basically these are slower moving trends, I would argue. Our identification, as I will talk about next, exploits more sort of these more discrete tariff changes. So we can try to control for some of these slow moving trends better. We've done some exercise and our results didn't seem to be very sensitive to that. Yeah. Yes. Thanks. I completely agree with all of this. We also, one thing that we do if you're worried about structural breaks, we do subsample analysis. So we look at the effects in different periods, and I will show you basically the results, how this looks. Great. So let me talk a bit more about the identification strategy. So our main interest is in major tariff events that really have the potential to affect the US macroeconomy. So what we will include are comprehensive congressional tariff revisions. So these are basically all the pre-1934 tariff acts, then multilateral tariff reductions, the GATT rounds, as well as broad-based temporary tariffs, for instance, the Nixon surcharge that I mentioned. What we're not going to focus on today are narrower or highly targeted tariff changes. So for instance, tariffs just levied on steel or on motorcycles, just to name a few examples. Legislation where tariffs were not the primary focus, as well as bilateral and regional trade agreements. Because, I mean, I'm not saying that these couldn't be potentially important, but obviously if you include all these bilateral agreements, this really increases the number of events substantially and also makes the narrative analysis pretty costly. That's interesting. I mean, we collected these events, so that's something we could test. I mean, that's more relevant in the more recent period where we have fewer events anyways. But I'm going to talk about predictability of our events just in a couple of slides, but that's a great point. So to do this narrative analysis, we draw on two main historical sources. These are basically historical accounts of US tariff policy. The first one is the fantastic book by Doug Irwin, titled Clashing Over Commerce, A History of US Trade Policy. It's really a nice book, so if you're still looking for some lecture over the summer, I highly recommend looking at it. And we also rely on Tausig's basically more classic history of US tariffs. We complement this to ensure completeness and accuracy with other sources, so we systematically cross-check with basically information from congressional documents, presidential speeches, the United States at large, as well as academic papers, government reports, and other things. Based on this information, we were able to identify 35 major tariff events, so basically events that fall into our focus here. And Yeah, over the period from 1840 to 2024, so the period we're considering here. And then basically in spirit of Romer and Romer, the narrative approach, our key goal was to classify these events according to their underlying motivation. So in particular, our goal was to identify events that we can plausibly regard as exogenous to current or prospective economic activity, because, for instance, they were driven by trade ideology, by distributional motivations, or for political reasons. So these will be the tariff changes of our main interest, but obviously then we will also classify the other tariff changes as endogenous if they were instead motivated by reasons to basically fund government spending for counter-cyclical considerations, to counter fiscal or external imbalances. Ricardo, yeah, or sorry.
Economic activity, I understand it's not just GDP, but
Uh-huh.
all in the economy.
This.
Tariffs are never developed, they're in response to some state of the economy.
No, well, it depends. I mean, to the business cycle. To the business cycle. Output, employment. So distributional aspects, we would actually, so distributional motives we will classify as exogenous, because it's similar in spirit to the Romans, right? So they also, yes, no, sorry, I wasn't precise enough. So it's really to basically the current and prospective economic activity in the sense of the cycle, right? So what we don't want basically are these endogenous tariff changes. So basically, if there is clear evidence that tariffs were levied to basically fund government spending, because then government spending may also have an independent effect on the economy, so we would confound that. Or basically instances where there was like clear counter-cyclical motivation. So I'm going to present some examples.
Now the endogenous, not February, you put external imbalance. So I don't want to have those.
Uh-huh.
Why is external imbalance more important than distribution and all the changes? That is an important endogenous element. So if number two, you would say, I don't want to spend your counter-cyclical element.
Okay. So the external. Maybe the word is not perfect, but these are like, say, an external shock, right? So for one instance that we would put in this category is sort of the oil shocks of the 70s. So there was basically the Ford fee that he imposed in response to that. So that's something that you don't want, because that's sort of in response to this shock that obviously also has an effect on US economic activity. While basically, if you consider, so I'm going to give you some examples of a distributional one there. Maybe there was more a worry that we treat manufacturing differently from agriculture. Maybe that's something because we have different constituents we don't want to do. So that's why we basically want to correct this differential treatment. But this is not motivated by like some reason related to sort of the cycle per se, but it's really about this distributional aspect.
In light of recent evidence, there shouldn't be doubt that tariffs can respond to the random thought of
Yeah, a lot of it is also just ideology, right? I mean, so I think the trade ideology, I think, is the cleanest. So I mean, you just have like two parties. They just have very fundamentally different views about basically what the ideal tariff should be, right? And then basically just for these reasons, for random reasons, one can set tariffs and then the other one can set tariffs, and these are basically plausibly exogenous. Yeah. Yes.
But if these were debated in Congress and there's a lot of uncertainty of what the outcome will be, that would be a nice way to check this. Because you also want that this is a surprise.
That's right. Yes. So we will talk a bit about anticipation. So that's obviously a concern. I'm gonna show some results on this.
Congressional evidence.
Yeah. Okay. Yeah. Gabe.
Comments. If I'm remembering my Romer 2010 properly, they had inherited deficits as an exogenous reason.
Yes.
For tax change. So it seems a little I don't know, awkward that you're putting under endogenous.
We think of this category a bit borderline, so that's why we're being more conservative. I mean, you could add those if you feel comfortable with that, but yeah.
It seems like it's not I think that's what Ricardo was sort of saying.
Uh-huh.
It's a little bit awkward if we're gonna all when you write these papers, to have one that's saying, oh, this one's exogenous, this one's endogenous. But the other comment on trade ideology, it raised some questions. This is an issue for, I think, this whole line of narrative approach. Do the parties differ on anything else systematically? And if they do, then that's a potential.
Yes. So that's a concern that basically other stuff could happen where basically one party comes into power. From our narrative reading, we could identify some instances of that. So as a robustness, we tried to drop these events from our analysis, and the point estimates didn't change all that much. Obviously, we lose a bit of power because we only have that many events to start with, but that's definitely something that we thought about.
Like the bottom two, like, it's really like pros and cons. Because really what.
Oh, yes.
On like maybe
Right.
and this is like, you know, like from the 1920s, like this is kind of how we characterize that early period, that there is a very pro-cyclical policy because they're very concerned about these balances, like they didn't want to work debts, so forth. And you know, the 1920s, we also saw this trade ideology, like different funds come in, we have different preferences for distribution of trade across the world.
We were just, I mean, one thing that worried us a bit about the fiscal imbalances, what was basically, if you put this into the exogenous ones, like the degree of the imbalance may be affected by basically by basically how the economy was going until that point, right? And that could create like some endogeneity through that. So that's why we thought it's more conservative to put them.
Now, my first part gets worse. I got to do something about it.
Right. Right. Yes, no, I agree. Yeah. Right. Right.
We had this kind of process
Mm-hmm.
which you are in concern about. It's a different type of concern to the ones they have to deal with.
Point taken. Yeah, I agree with that.
Sorry, point again. What was
I'm gonna give you examples. Yes, so that's why, like in a robustness check, we excluded that one and didn't change our results that much. Excellent. So this is basically the classification we came up. I agree, it's not exactly the same as Romer's. I think we're being a bit more conservative than them, but yeah, we're obviously open to suggestions on how to improve this. So let me talk a bit more about this political nature of tariff action. I've already hinted at that a bit. So after the Civil War, US tariff policy really oscillated sharply with partisan control. So Republican administrations usually enacted or defended high protective tariffs. Democrat victories were typically followed by tariff reductions. And what's interesting is that basically under similar macro conditions, so weak growth and high unemployment in the 1890s, this produced opposing tariff responses depending on the political majorities. And sometimes Republicans even basically enacted some tariff reductions, basically for strategic reasons, because they worried maybe they lose political support if they don't do something. So to avoid basically that Democrats will win in the next round of elections. So I promised some examples. So let's start with the McKinley tariff. So this is an act from 1890. So in 1889, the Republican electoral victory resulted in the first unified governments for quite a while. And so in May 1890, William McKinley presented his tariff proposal and stated, I've interpreted that victory to mean, and the majority in this House and in the Senate to mean, that the revision of the tariff was not only demanded by the votes of the people, but that such a revision should be on the line and in full recognition of the principle and purposes of protection. So there is like a clear protective intent, so to shield the domestic economy, and it's for ideological reasons. And basically they interpreted their victory as a mandate to do that. So that's a case that we identify as exogenous, and also the narrative account around that period didn't point to any obvious confounders here. An example of an endogenous tariff change was the emergency tariff from 1921. So in the 1920s, the United States fell into a post-war recession, resulting in severe deflation. So a report by the United States Tariff Commission in 1922 notes the emergency tariff was passed in the midst of the greatest decline of prices that has occurred in many years. not only were prices falling in the United States, but similar movement was going on all over the world. In fact, the demands for the emergency duties largely grew out of the demoralization of world markets. So this was basically enacted during this recession to protect particular farmers facing collapsing prices. So that's why we label it as exogenous. Out of the 35 tariff events that we have identified from our narrative analysis, we classified 21 as exogenous. Importantly, basically, we will only focus, at least in our baseline specification, on the timing and direction of these tariff changes, not the magnitude. There are two main reasons for this. First, it's pretty hard to measure actually like what a tariff change implied in terms of the change in the statutory rate in a consistent way over time. So we're collecting some data to improve on this. And the size of the tariff change obviously may also be shaped by economic and fiscal considerations. So we also think that basically the identification requirements are weaker if you just focus on the timing and direction. Importantly though, so I'm gonna give you the IB intuition more formally later on, but for our identification purposes, we just need something that's correlated with the tariff shock that we want to identify, uncorrelated with all other shocks. Yes, I mean, not exactly all the same. So in fact, you can show that basically the weighting depends also on basically the expected size of a given change. Say if you allowed for individual weights for all of them, and there was some heterogeneity there, but yeah, we computed the weights and yeah, it's relatively equal. We don't necessarily think that's a bad thing because that basically makes you less vulnerable to outliers. And as long as like you have enough power in the first stage, I think that's just a conservative way to estimate this. Yes, please. Mm. Yeah. Big, yeah. Right. No, I think that point is well taken. I mean, what we're going to recover is sort of an average treatment effect. This will mask underlying heterogeneity. And I think it would be fascinating to explore this more. It's just like with the 21 events that we have, we don't have a ton of power to do more, but it's definitely something we can try. So this is basically the narrative tariff shock series that we recover. I'm happy to talk more about it, but I really want to show you some results. So let's go forward. Actually, this series has some desirable properties. So what we find, somebody asked about forecastability, is that our exogenous tariff dates, they're not forecastable by past macro or financial variables. So we include here basically a pretty rich set of predictors. What's interesting though, if we focus instead of the dates that we classify as endogenous, there we find that actually they're forecastable. And in particular, you see, I mean, prices, some of the trade variables, they seem to be important to forecast these. We also do some other diagnostic checks. In particular, we show that they're uncorrelated with other structural shocks measures put forward in the literature, for instance, fiscal or monetary policy shocks. So I hope I could convince you that this is like a sensible proxy for a tariff shock. Please, Emmy.
Before
the endogenous one? Or
oh yeah, was it? Oh, that was an endogenous one. So that was the commodity price.
Yes.
Worldwide. That was
Yes.
an endogenous
That
one.
yes, that's right.
Is that example? So later on, you're showing us all the things that predict the endogenous.
Yes, that's right. Yeah.
Tariffs. So I guess you have what interest rates, the S&P 500. Do you have like a story for what?
Well, I mean.
Things to be later. Is another one.
Yes. I mean, one story is that basically changes in prices create this endogeneity in the average tariff rates, how we measure this. And basically, that could be part of the story. But yeah, I mean, I have to think about it more, but it's a good question. Yes, please.
For the reciprocal trading, professional fiat schedule, they did so about every 7 years. So definitely there's a predetermined provision. Provision that endogenous could stay up to that point, and then it's fixed. Basically, tariff schedule is fixed thereof. So all the variation you see between or the economists do quality, it's compositional, or the effect of prices changing nominally as you kind of make a stand whether you think nominal price change is neutral economy, and if you do that part of the index as well as fair. If you're in a sticky price environment, that's what. So, but the legislative rate is step up.
Right. Yes,
The other-
that's right. Yeah, absolutely. But I mean, for our purpose, I mean, we would like to better measure this. So we're working like collecting data on the statutory rates, but basically right now we're not exploiting any information on that. We're really just focusing on the event date, and that's basically all the variation we exploit. Okay, so in terms of this brings me to measurements. So obviously we need sort of a measure of the tariff policy stance in the US. So following the literature, we use average tariff rates. Specifically, the due tariff rates is our preferred measure, and this is because these revenue-based rates are noisy proxies for the policy stance. They reflect also non-policy variation, and maybe it's a bit less acute for the dutiable rates because they're basically you just normalize by dutiable imports and not total imports. But these measurement problems also highlight another benefit of the IVY approach that we're doing, because basically using our instruments, we can not only address the endogeneity concerns, but also to some extent this measurement error in this series, because we don't rely on a basically exact measure of this stance, just basically has to be a proxy, and then our instrument will basically, IVY approach will be robust to measurement error in the instrument. We also construct a new US historical data set spanning 1840 to 2024. I'm happy to tell you more about the data construction, which was also quite a bit of work offline, and we will be planning to share this data online. So if you're interested in this, just reach out to us. Great. So in the interest of time, let me skip this and let's jump basically to the main results. So our econometric framework will be basically this impulse propagation paradigm. So we think of the economy as driven by different structural shocks affecting the economy and propagating through basically these B coefficients. And what we're interested in is a tariff shock. So this is epsilon 1. So to identify this, we need an instrument. I've shown you the instrument. That's basically our narrative. Tariff dates, plausibly exogenous tariff dates. And the IVY assumptions are basically that this narrative proxy is correlated with the shock of interest, but uncorrelated with other shocks. We estimate with VARs as the baseline, but we also do local projections, and it's pretty consistent. So this is what comes out. So this is the impact on trade. So you can see a tariff shock leading to an increase in the tariff rate by 1 percentage point on impact leads to a significant contraction in trade activity. So you can see real imports basically collapse on impact, and then the fall is pretty persistent. For exports, it's a bit more sluggish, right? So there isn't a significant effect on impact, but then basically falls in a more gradual way, and the terms of trade actually improves. So turning to the economic variables, it's interesting because yes,
the implied trade elasticities are huge.
They're big, yeah, they're big. Yeah. So despite the fact that terms of trade improves, it turns out that basically these shocks, they're contractionary. So we find basically a fall in real GDP, a fall in manufacturing production. Turning to prices, you can see that the GDP deflator increases slightly, but it's not super precisely estimated. And real compensations, or proxy for wages in the manufacturing sector, also decline. Because this is a monetary economics meeting, let's briefly talk about some variables relevant to monetary policy, even though, of course, over such a long period, the Fed for part of it hadn't existed. It's a bit hard to think about, but basically it seems that there isn't a significant response to the real short rate. Consumer prices also increase, but it's a bit more pronounced than for the GDP deflator, but pretty similar. And we don't find that the shock strongly propagates by affecting financial markets. The real exchange rate, though, appreciates slowly. Yes.
Dynamics. Shock that you measure.
Well, I mean, this could embed it also. I mean, it's still elevated even 4 years out significantly, but yeah, it tends to mean revert somewhat. But this doesn't mean that the underlying change in statutory rates is mean reverting, right? Because this could also reflect behavioral responses which affect the average tariff rate.
I think you find effects are quite persistent. Effects, stronger for treatments.
Yes.
Is this consistent with standard model, or is this a surprise?
For the persistence, yeah, that's interesting. I think, I mean, if you look at the trade models, they don't have dynamics that much. So you can look at some international macro models, but then you also need peculiar features to get like these more hump shape behaviors. I wouldn't say this is like surprising from an empirical macro perspective, but yeah, I think it would be interesting to see whether you can get the dynamics right. In terms of magnitude, I think you can get this in models, but it's also probably at the higher end of what like standard calibrations would imply. Yeah. Yes, so we do have results on that. So hope, maybe I can show you, but yes. Uh-huh. Yes. Yeah, the problem is, I mean, and that's also something that comes up, like if you know the Mertens and Round paper, right? The problem is basically if the base shrinks away, the multiplier is not well defined. So and that's a bit the same issue here. So we try to compute this, but they seem to be not really well defined. So that's a challenge.
But what's the interpretation of the magnitude? So the tariff rate is measured through the metric of revenues over total imports that you.
Yeah, so the tariff rate is basically defined as this is duties collected over dutiable imports.
Okay, and if that goes up in
1 percentage point.
0.01%.
Yes.
The response of exports is 2%. It's not quite a trade elasticity.
Right.
What's the share, what's the GDP on average?
It's around 5. I mean, it depends on in the more recent period, I think it's above 10%. Historically, maybe it's below 10%. Oh, dutiable ones. Yeah, I would have to check. I would have to double check. I'm not sure. Yeah, maybe.
And strong 5% like average, their overall revenue increase. So,
Mm-hmm.
but this is like this.
Yes, I mean for that, I think, I mean you could do a back of the envelope calculation using basically the magnitude of a given shock, which we're not exploring. The problem here is like because you have this endogenous response of the economy, which will also basically reduce revenue. That's the problem. That basically, yeah, on just an impact. Yeah, we can look at that. Yeah, yeah, yes. Okay, no, we can look at fair. That's a good point. Good. So in the paper we go through a bunch of identification concerns. I don't have time to talk about these now. So just because somebody has asked about retaliation. So one thing that we do is to basically look at how these estimates vary over time. And we do find that they're pretty stable actually for most periods that we look at. Where it really differs is in the post-World War II period. And I mentioned this so you can see that basically real GDP falls more immediately. And that's because basically exports contract significantly on impact. And that's in line with the story of retaliation. So basically, we basically constructed a measure of foreign tariff rates. And then basically we looked at how these tariff shocks affected foreign tariff rates in these two sub-periods. And you can see sort of in the pre-World War II period, there is only little response. And after that, there is a more significant response. So that's sort of consistent with these responses. So I'm out of time. Thanks you so much for engaging. I hope I hope this is useful. So we construct this new narrative tariff instrument that you can use to basically study the effects on tariffs on different outcomes. We focus here on the US, but obviously could also look at basically spillovers on other countries. There's lots of interesting things to do here. Yeah, thanks you so much again.
We have a few more minutes if there are additional questions. Yeah.
So if there is no retaliation, the foreigners were showing that sometimes they don't retaliate. Why does GDP decline or industrial production decline? I understand that if I'm an importer, if I need some imported input, it is bad news for me, but it should be good news for all those affected input and now get sent. So what is the challenge with that?
For the falling, I mean, it takes longer to materialize.
That's a central argument why Trump is saying this.
Yes, but
that's because the foreigners are being chicken out, and we are going to have higher GDP because our exports are not going to decline.
That's right. But I mean, oftentimes these arguments, they sort of they work like in a partial equilibrium logic. So here basically we have an aggregate effect. I mean, it's true. I mean, there is also some retaliation in the earlier period. It's not that significant, right? So it's not exactly zero. But yeah, that basically what comes out. And then in terms of the precise effects, I do think if you look at models, you can also get even with no retaliation, negative effects in standard calibrations. But yeah, I mean, yeah.
A simple Bernoulli symmetry, you do get the exchange rate appreciation, so it could be that somebody suffer from the appreciated exchange rate. Which then contracts the yeah, the two-thirds. I've done the multi-centric EGS, the exercise for the period, some of the other periods, but a lot of intermediates were taxed, so they have downstream efficiency. So that reduces U.S. efficiency. Consumption tariffs are smaller as a share of GDP. I think it's relatively minor, but at least in the long run. It would be useful for you to carve out that period, just compare it. But we could view that as a counterfactual. We take the foreign domestic index, give it asset fairly substantial model, see if the exogenous or endogenous costs.
That would be interesting, yeah.
The reason we did that is there are lots of other shocks going on. So trying to get what fraction of GDP variation could cause it. And it was like that post-war recession. Hey, it's not a depression. So that helps to kind of frame what you identify.
Thanks.
Some winning from this fault.
Oh yeah, I mean, this is not saying that, yeah, this is not, I mean, here we really look at an aggregate perspective. We would love to look at basically more disaggregate impacts. It's just with the long historical sample, it's really hard to get the data to do that. But this is not saying that like some places or some industries may win. I mean, the statement is though, if you look at manufacturing production as a whole, it still seems to fall overall, but this doesn't mean that like some may win actually. Yes, that's, well, it depends how wedded you are to your ideology. Yes. Yes, that's a great question. So looking at the variation here, we have many more negative ones. So basically, if you just focus on the positive ones, obviously you have much less power, but we found at least qualitatively similar impact. Yes.
Before showing and we hinted at this too, that the transmission depends on monetary. So like you have dates, but IRG might also be.
Yeah, thanks for the question. So this was the part that I skipped because I ran out of time. But we look at this in the paper. So just very briefly, so we actually like when we look at the period under gold-linked monetary systems, we actually do find basically what you would expect. So the trade balance improves. Then there is an adjustment through gold flows. So imports fall, there is less outflow of gold. And this implies that money supply expands. So that's like one reason why we think we find this bigger price response in this period where you had gold-linked monetary systems, because this will be absent in the period after. And basically you can also show this here. So here we do a pre-World War II and post-World War II split. And particularly the current account response, right, is very illuminating. So you can see it increases in the earlier period, but actually falls in the later period.
Okay, well, let's give Diego another round of applause. And that's it for monetary economics. Thanks everybody for coming. Till next year. Till the fall.
Oh, yeah.
Yeah, thanks for putting me in the program.
Yeah.
Yeah.
Good to see you.
It's really-
It was great.
Yeah. It was
Yeah,
great.
work a lot.
You and Annette.
Right. Yeah, I'm actually writing a chapter about these exact issues.